Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith. Let's bring you the three things that you need to know this morning.
Good morning, everyone. First up, stock futures wavering this morning after the S&P 500 closed lower in Monday's session, extending its decline after the benchmark saw its worst sell-off this year. Investors grappling with potential growth headwinds here posed by the Trump administration's tariff plans, which the president said are, quote, on time and moving along very rapidly following an initial delay.
Plus, investors digesting the latest earnings ahead of NVIDIA results tomorrow. Home Depot rising this morning despite the world's biggest home improvement retailer expecting sales to rise by less than expected this year as consumers remain cautious on large home projects. Meanwhile, NVIDIA out tomorrow after the bell. Investors will be closely watching for the potential impact of chip curbs on China following a Bloomberg report that the Trump administration is looking to toughen Biden-era rules.
And the sell-off in crypto gathering steam this morning, with Bitcoin dropping below 90,000 to its lowest level since November. Macro pressures on risk assets fueling the drop, as well as souring sentiment following the biggest ever crypto hack targeting exchange Bybit. Stock futures wavering this morning after stocks struggled to recoup losses following Friday's sell-off here. We're taking a look at some of the pre-market activity. We are mixed right now for the Dow and the S&P 500. We're in positive territory. However, taking a look at the NASDAQ, still got a little bit of catch up on that one. It's flat, but to the downside here. I guess you could say the S&P 500 as well is flat here. We're getting even more earnings rolling out. We're going to dive into one of those big names here, but ultimately, as we think about what the markets are continuing to try and weigh and ultimately prove resiliency through, it is a lot of the tariff talk and the will they, won't they ultimately roll these out at the start of March. That is the core dates that we're continuing to look at here, and especially as even more of the geopolitical conversations are taking place. Macron taking a visit to the White House as well. All of these things considered, it's all about the tone that the president looks to strike and then what that could potentially mean for some of the additional tariffs he looks to levy in some of the negotiation tactics that have been rolling out within the first, it's only been a month. Just 4 weeks since the inauguration.
It's like a long month. There certainly has been no shortage of headlines, no shortage of topics for us to talk about. But I think what's interesting here in the market reaction that we have seen, the market action that we've seen over the last couple of trading days is more this risk-off sentiment. Yes, you are seeing the Dow right around the flat line. You are seeing the S&P hover there as well. But again, you're looking at tech under a bit of pressure with the NASDAQ on track to open the day in the red. You take a look at the move to the downside when it comes to Bitcoin, some of the crypto related trades. Yes, obviously, certainly that is a headline driven and very much market specific. Maybe when you dig underneath the surface and see some of the headlines that is driving and that move to the downside there when it comes to the hack and ultimately what that means here more broadly speaking. But I think when you take a look at the equity market, when you take a look at the fact that yields right now are the lowest that we've seen since December, we certainly have seen this risk-off sentiment certainly creep into the markets. And we're seeing more and more strategists point out in their notes over the last week or so just about a little bit more concerned about the slowing U.S. economy right now and whether or not this is the start of the trend, if this does continue for another month or two, just ultimately what that signals just in terms of whether or not the market's going to be able to continue to shrug off some of these slowing concerns.
Yeah, you talk about those strategists. We got a note just this morning as well from UBS, and their chief investment office continues to expect volatility. However, they are believing that the markets are likely to refocus on fundamentals, they say, that should support the equity rally further here. Three of them that they're really pointing out here. One, China internet remaining attractive on solid fundamentals, they say. Tariff headlines should be considered in the context of broader U.S. economic health. And then lastly here, the third to round it out, AI rally, they say has further to go. And that next test could be just later this week when NVIDIA reports.
Let's talk about that because chip makers are wavering this morning after dropping on reports that the Trump administration is planning to expand efforts to limit China's technological advancements. The clampdown would include tougher semiconductor curbs and pressuring allies to escalate restrictions on China's chip industry. With us now for more, we want to bring in Ben Bajarin. He is a Creative Strategies CEO. Ben, it's great to have you back here. Great to have you on Yahoo Finance. Let's talk about how much is at stake here for the AI trade. Obviously, obviously, when you take a look at the report that we will be getting after the bell tomorrow, what is that indicative of? Just how critical are NVIDIA's results to the overall momentum of the AI trade?
Yeah, I mean, I think anybody who's followed NVIDIA long enough knows that their CEO Jensen Huang has a pretty good point of view of where things are going. I think they're a very good predictor of demand. They obviously see their roadmap and what their customers are looking to do, not just buy GPUs, but to really run that software and what future models will look like. So I think regardless of whatever the estimates are, I mean, I've seen everything from flat to strong beats and raises. Right, the bottom line is the demand for GPUs remains incredibly strong. And I think a lot of people are going to be looking for that commentary as to how do they set the market and how do they maybe talk more about full year demand, what they're seeing, because I think a lot of people still have a lot of questions about full year. And I think Jensen's going to be in a position to bring a lot of commentary to that as well. And a lot of what he says will help seed and bring some lift to that market, not just this quarter, but really for the rest of the year.
Ben, when we do see dips in AI-related tech stocks here, how can investors aptly decide or make sure that they are evaluating the difference between quality AI stocks versus those who are just slapping AI on something and saying, hey, we're leveraging it and it's going to prove to be more efficient for us?
Yeah, I mean, I think there's some fundamental technology differentiators that any good play here is going to have, right? I mean, semis is one of the biggest ones, as you see, and you see some of the most popular names, not just being NVIDIA, but being Broadcom, Marvell, obviously AMD's in there, and I think people want to see more in terms of what Intel's got up their sleeve, not just from product, but also manufacturing, because manufacturing AI chips, as we've seen with TSMC, another one, right, ASML, these are fundamental companies that at a technology level aren't going anywhere and provide, critical underlying technology for the AI industry. I think there's some other elements in software that's going to be interesting. I know a lot of people talk about when are we going to see monetization in software from the hyperscalers. Everything we hear in terms of numerous CIO, CTO conversations continues to suggest that those enterprises will start to move from pilot to full deployment at scale toward the end of this year and into 2026, which again means that you've got to have all of that infrastructure in place to start inferencing at scale. So we think you're going to continue to see that wave, and I think there's those hardware and chips and then software and the hyperscalers and others where they're going to start monetizing this infrastructure toward the end of this year.
Ben, when you take into account the reports that we're getting just that the White House could potentially crack down even further on some of these chip export controls, what's the ultimate impact, do you think, to some of the leaders within the space?
Yeah, I mean, the big thing, like we've seen with tariffs in the past, is really just going to be an impact on margins, right? We don't think that this is going to slow down the sales of any of these things. And I think, when you look at the demand versus sales in any quarter, right, the big thing is just to say, like, well, we're not losing sales. They might be pushed to another quarter. They might be delayed, but they're not lost. And I think that's the part of if somebody decides to not buy this quarter, but next quarter, or whatever those dynamics are, we just continue to see so much demand for AI infrastructure, and we believe that will continue, that it's really going to be a margin question, which then comes down to who has margins to give. And there's a handful of companies, there's not many, but there's a handful that can absorb those. And there's many where that will be more margin pressure, which will have a much dramatic impact on earnings.
What do you think DeepSeek exposed about the AI trade right now, or perhaps even about some of the froth that's around the trade?
Yeah, I mean, the biggest thing is it doesn't change anything in terms of demand. I mean, I think we have been wanting cost per token, right, from an inference standpoint to come down for a while. That's been predicted for years. The question was when we'll see models that can do things which we call reasoning or long thinking types of models for inference. Everybody wants these costs to come down. To be honest with you, we need those costs to come down so enterprises can move from project to deployment, right? Because if you just think of how many people in your enterprise are going to be querying or inferencing, doing any type of agentic research on a daily basis, if you're paying whatever 10, 15 cents per token, that could get pretty expensive. If you're paying 1 cent per token, that's much more economically friendly for your enterprise. So we want those costs to come down. Those costs come down so consumers can use Gen AI. Everybody who wants to monetize and have ROI on this needs those costs to come down. And that was the positive from DeepSeek, is that it really can do deep thinking, high forms of logic at lower cost and at efficiency. And I expect every model to follow suit, which will be very, very good economically for this industry.
But very much so going into this and ahead of the DeepSeek revelation and some of the advances that we learned about, NVIDIA very much viewed as the golden child almost when it comes to the AI revolution and adoption. Does DeepSeek at all change that?
No, I don't think it changes anything. I think, again, what you're going to see is more models follow suit. I think the big positive here was really just the opportunity for open source. This has been a real big question. When you look at any enterprise survey today in terms of those enterprises I was talking about who are in project mode, it's like over 70% of them are using OpenAI, which is a closed model. So if that continues, great for OpenAI, great for Microsoft, who will benefit from the bulk of that infrastructure. But the reality is there's a lot of enterprises out there who will take a very good model that is more open source, that they can tune themselves and deploy either on-prem, on-device with AI PCs or AI smartphones, and those need to be open source. So I think what that did was just bring this question back to what does open source mean for this industry? Again, we don't know the answers. We're still in maybe inning one of the AI momentum that we have here, but it's good for open source, and we hope Meta does models there, Amazon has others. We hope that that's good. To just bring more variety and more competition to the LLM space.
Ben, just lastly while we had you, you mentioned Intel earlier in the chat here, and I just wanted to get your outlook for what the recovery story looks like for this business. It sounds like you believe there could be a recovery story. Is it a sum of the parts that ultimately then gets put into some type of deal conversation?
Yeah, I think you've always got to look as the product portfolio, the whole sum of the parts, like you said, of Intel. I think there's two things going on that we should be really focused on. One, what are their technology differentiators from a foundry standpoint? I followed this rumor around TSMC and others as a joint venture, and when you looked at how people were valuing Intel, or at least how they were valuing foundry, they were valuing its book value really just in assets. There was no much percentage of increase on that in terms of what a deal could look like for core IP. Yet at the same time, we know that Intel Foundry has a lot of very good core IP that they've been developing, and that should be worth something. And so I think we've got to take into account what are they doing with underlying manufacturing technology, things like power via, innovations in backside power, what they're doing in transistors, in design. We need to think about that the same way that we think about what TSMC brings to the table that differentiates their customers to go and compete and design products. So it's a foundry story. And then I think a lot of people honestly miss that the CPU is still highly relevant to AI infrastructure. It's one of the most critical parts to reduce latency, to manage the orchestration layer. And so I think we forget, we get really caught up in GPUs and custom ASICs, and those are all great. But you look at what's going on, and AMD and Intel are both in this case, is that there's actually a really nice upswing for designed CPUs that are built from the ground up for AI. And we don't have those yet. We have legacy CPUs running AI. And eventually both those companies, I think, will participate in the CPU side of this side as well, and be able to charge higher prices and play a more critical role just from the CPU side. So I think from Intel, you've got both of those. You've got product with a lot of opportunity, and you've got foundry with a lot of opportunity. But the point is, it's a long story. I think that's what people have been frustrated with Intel is it's going to take time. It's not next year. It might not be the year after. It's more toward the end of this decade. And I just worry people lose patience.
We didn't even let you know that was a topic we were going to talk about. Ben, appreciate it. Thanks so much.
Yeah, thank you. Thanks for having me.
Certainly. Home Depot narrowly beat sales expectations in its fourth quarter. The home improvement retailer posted positive same-store sales growth for the first time since 2022 after 8 straight quarters of declines. Here with more on the results, we've got Yahoo Finance's Brooke DePalma. Brooke, what do we know?
Good morning. Well, investors were certainly excited about that same-store sales growth, the first positive results that we've seen in 2 years from the home improvement retailer. But investors also a bit disappointed when it comes to a cautious guidance that the executives set out amid higher interest rates and stubbornly high interest rates that are really causing consumers to continue to push off those larger projects. And if we could take a closer look at that 2025 guidance here that disappointed investors, total net sales expected to grow 2.8% in fiscal year 2025. We also know that same-store sales growth expected to increase just 1%, and adjusted diluted earnings per share expected to decline approximately 2%. That's really causing some disappointment among Wall Street this morning. Now, sources that I've spoken to this morning said that did prove a bit conservative amid this uncertainty within the home improvement sector, but executives are hoping that consumers ultimately get used to these higher interest rates and pursue these higher projects, or rather higher higher ticket projects that they've been pushing off. Another thing is that exciting same-store sales growth that increased 0.8% in the quarter. Once again, that is positive results for the first time in 2 years, and that was largely boosted by Hurricane Milton and Hurricane Helene. That boosted results by roughly 60 basis points. It also reflects growth within their pro-heavy categories like roofing, drywall, and lumber. Also strength in e-commerce. That was up 9% for the quarter, and all that really led to positive foot traffic. That increased 7.6%. That's the best foot traffic that Home Depot's seen in a quarter in nearly 3 years. That's compared to a decline of 1.7 in the prior year. Now, one thing that has Wall Street also excited is this acquisition of SRS that happened last June. We're currently listening to the call, but CEO Ted Decker said so far in the call, he called it additive and complementary. He also said that it contributed $6.4 billion in sales for the first 7 months that it's owned this distribution for residential professional customers. So really focusing in on that pro business here. SRS is expected to bring in, grow mid-single digits as far as organic sales grow in fiscal 2025. So lots of excitement around the pro business, but consumers still pushing off those higher ticket DIY projects.
Well, they'll be very pleased to know that DIY projects for home improvement are very heavy in my algorithm right now. I don't know why. I don't even have a home.
Hey, what do you have in the pipeline that I don't know about?
Nothing. Just a IKEA Billy bookcase in the shopping cart.
That is exciting.
Yeah.
Gotta start somewhere.
Yes, you do. All right. Well, Brooke, thanks so much for starting off our day like this. As we head to break, let's get a check-in on shares of Palantir. PLTR is the ticker symbol. We are taking a look at shares right now. Pre-market up by about 1.7%. However, that is not going to be enough to erase the slippage that we've seen over the past few sessions here, as PLTR shares have been down, especially on some of the reports about cost cutting at the Pentagon and more broadly what efforts the Department of Government Efficiency might put forward in order to try and slash some of those costs. The slippage has been bad over the past 5 days, down 25%. We'll continue to track that going into the opening bell. We've got much more ahead on Morning Brief. It's now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, shares of Hims & Hers plunging after the company confirmed it will stop selling compounded versions of weight loss drugs, and as analysts cite an uncertain year ahead. Yahoo Finance discussed the results with the company's CFO. Take a listen.
We do fully intend to abide by all regulatory requirements, and when necessary to do so, we'll remove all commercially available dosages of semaglutide from the platform. So embedded in our guidance is after the first quarter, assumed in our guidance is no revenue from commercially available dosages of semaglutide.
And as we're taking a look at shares here this morning, we were continuing to track that slippage here for Hims & Hers. One of the other things that came up within the period, even though they did demonstrate some robust revenue growth, 69% year-over-year increase, it's still more about the outlook here that they're communicating to the analysts and the street here that's rattling or ruffling some feathers right now.
Yeah, it certainly is, especially when you compare that to the reaction that we're seeing in names like Novo Nordisk. You're looking at shares pop there on the heels of what we're hearing from Hims & Hers. You're looking at the highest level that we've seen since late December. You're also looking at Eli Lilly moving to the upside. Of course, much of that is because of the fact that Hims & Hers will no longer be selling some of those compound weight loss drugs, obviously, after the fact that it's no longer declared a shortage. I think the big question for Hims & Hers right now is just what exactly that growth trajectory looks like, right? Without the demand and without the revenue from the compounded drug, just ultimately what that looks like. Obviously, a bit concerning here for investors. That's clearly reflected in the share price. But remember, this is a stock that has come so far, so fast, especially when you take a look at some of the short interest even involved in a name like Hims & Hers here most recently. And when you take a look at some of the gains over the last year, it's just been incredible to watch here. As I pull up the 1 year chart, I believe we're looking at gains here of just about 438%. Even since the start of the year, you're looking at gains of over 100%. So again, obviously, coming a bit back down to earth, you look at the short interest within the stock, it makes a lot of sense why we're seeing the type of volatility that we are.
Yeah, one of the things that we continue to remind viewers of as well is what is widely regarded as this patent cliff. Between now and think out to, 2033, there are going to be a lot of brand name medications that have had intellectual property, had patent protections that are going to be rolling off. And for Hims & Hers, what they've been able to do is identify which they would ultimately be able to mass produce at scale and quickly get into their own sales ability and take that to market as well at a perhaps lower cost and take that to consumers. And so with that patent cliff, that presents an opportunity. However, in this near term, for the GLP-1s that they had run Super Bowl ads about and tried to make sure that their brand stays top of mind for consumers, it certainly is a longer lead time that it seems like it might take in order for them to be able to capitalize on some of those patent cliff roll-offs here, which could account for about $400 billion in revenue lost by some drug companies here, as evaluated by one of the, I think Morgan Stanley put out the $400 billion figure there. So we could see some M&A, but we could also see a Hims & Hers trying to make sure that they identify which solutions they can then take to market as well.
Let's take a look at PayPal. PayPal making several announcements ahead of its Investor Day getting underway right now. The company predicting growth in earnings and transaction margins in the coming years. Its new leadership team continuing to streamline the sprawling business. You're looking at gains of almost 3% here in the pre-market. There's a clear focus at PayPal, and this has been the case now for some time under their CEO. It's one of sustained profitability, and they're laying out ways in which they see themselves achieving that. Obviously, when it comes to slimming down parts of their business, they also announced plans to unite all of their retail-focused services onto one platform that's going to be called PayPal Open. That is making some progress here. When you talk about some of the other initiatives, clearly 2024 was a transition year for PayPal. So they're emerging from that. Their CEO, Alex Christ, saying that they executed on exactly what they started out and planned and wanted to accomplish there. So now it's more so about refining some of the priorities of their business right now as they do try to have a real focus on being profitable. And that's something that the street has been very welcoming, obviously, to no surprise, and excited to hear time and time again from their CEO.
Well, I'm helping. I'm doing my part. I'm within this Venmo category here where I always do a control or command F, whatever operating system you're using here. But one of the product level expectations that the company had put out, looking for PayPal and Venmo debit total payment volume to be $50 billion and growing at a greater than 25% CAGR, compound annual growth rate, by 2027 here. Also did a little bit more searching on Venmo for all you people out there who are perhaps expressing those funds into your bank accounts and whatnot. Either way, they're expecting about $2 billion Venmo revenue by 2027. That is a low teens compound annual growth rate that they would be looking for as well. And then even more growth within the debit card options for Venmo. So the Venmo category is really what they've been banking on, as that is more prone to carry a lot of younger users that were on the platform. Perhaps not those who are the native or old school PayPal users who were checking out on eBay and then saw the spinoff, which I actually had the opportunity to work on in a past life. But all these things considered, Venmo and the younger users, they are core to these compound annual growth rate expectations for the company right now.
Yeah, they're also touting their ability and where they're positioned within the cryptoverse compared to some of their competitors out there, talking about the fact that they're enabling consumers to buy, hold, and sell digital crypto via their PayPal and their Venmo accounts. And their CEO, Alex Chris, going on to say that we just enabled hundreds of millions of users and tens of millions of merchants to be able to spend their crypto instantly for their everyday purchases, saying that that is another thing that separates them from the competition.
Have you bought anything with crypto yet?
Nope.
No?
Have you?
All right, maybe this year.
You never know.
Yeah, we'll see.
Never say never.
Finally, yeah, there's a song in there somewhere. Finally, Unilever announcing a leadership change in the coming days. The company's current chief financial officer and 37-year company veteran will replace its current CEO on March 1st. The current CEO will stay on to help oversee the transition until May 31st here. And it doesn't sound like this was entirely expected here. This comes after Heinz Schumacher was in the position for less than 2 years. The board doesn't sound like they were satisfied with how quickly some of the restructuring was taking place there.
They were, and they wouldn't. I think you can make the argument that they didn't really give him a chance to really embark on this turnaround strategy for being there.
2 years is short
less
for a
than
CEO.
2 years. Yeah, we also know that Unilever has been under a tremendous amount of pressure from activist investor Nelson Peltz. Now, he has been very vocal. Initially, he was very much in support of Heinz Schumacher when he initially took over as CEO. Obviously, has had a little bit of a change of heart. So this coming now after the board ousted him as CEO, again, less than 2 years on the job. And you mentioned the fact that this came as a bit of a surprise. RBC saying, quote unquote, that they were gobsmacked by the news. They didn't see this coming at all. So I think that in that line explains it all. All right, keep it right here on Yahoo Finance. You got much more coming up. We've got the opening bell for you when we come back. And that's the opening bell on Wall Street. Let's do a check of the markets as we begin a brand new trading day. You are looking at some gains, I think we could call it there, and be excited about here for the Dow. We are just above the flat line here, up just about 100. But when you see some of the pressure, more broadly speaking, obviously tech still in the red. When you have to see some pressure from the Nasdaq, you do have the S&P right at the flat line here at the open. Not too much movement here, but the big question here is whether or not we are going to be able to regain some of that momentum. How much of that is going to be hinging on the results that we will be getting from Nvidia tomorrow after the bell. Taking a look at the Nasdaq, under some pressure here this morning, off just about 0.3%. I do want to pull up some of the action that we are seeing in the bond market here. You are seeing this move lower in yields, actually the lowest level that we've seen in yields since the start of the year. So again, when you see that move lower here, we are seeing bond prices move to the upside. And also the VIX, the volatility index, just to call that out, we are around the highest levels, I believe, that we have seen since the start of the year. You pull back that year-to-date chart there, you can see right around the levels that we saw in early January there. So again, some of this move to the upside. And taking a look at the sector action here very early in the trading day, you are looking at a lot of green, or a little bit more green on the screen. You got financials up just about 0.5%, consumer staples also not too far behind. On the flip side, because of the Nasdaq, you're having the tech sector, XLK, that's off just about 0.2%. Utilities, the worst performing so far, just here at the open, off about 0.6%. Jared Blickery is standing by with a closer look at some of that movement that we're seeing. Jared.
Thank you, Shauna. Yes, we are seeing kind of a risk market breakdown here, and I'm going to go back to back to the major indices. I'll put a 5-day chart so we can see the S&P 500 and what it has done recently. Yesterday, I think, was very instructive because we started out with a little rally, and then we got into yesterday and the day before's territory, into Friday's price action territory, and then we just sold off pretty hard. Let's take a look now. This is the S&P 500. Let's put a 4-day. Well, it looks like the charts aren't cooperating this morning, so I'll just tell you that the VIX has been up 4 days as well. Small caps leading down today. And let's see if we can get a chart of the 10-year T-note yield, and I'll just put the quotes on. That is down 8 basis points, so 4.32%. We haven't seen that in about 2 months, and that's fairly significant. And I've been highlighting that lower yields are generally good for risk markets, but that's always contextual. You don't want yields falling in terms of a safe haven flight into bonds. Bonds move inversely to yields, so bonds are going up right now. Let's get to the sector action because not everything is going down. Consumer staples has been going up, but that is a defensive sector, and we'll see if I can get a 5-day chart on that. That has been heading higher 2.5% over these trailing 5 days. And another sector that's not doing so well, but in the consumer sector, is discretionary. And XLY, that had been down 6 days. Today would be the 7th day, and that is an Amazon and Tesla story. The weakness that we've seen in Amazon, because Amazon is down 6 days in a row as well, that has been a more dominant factor. But we know that Tesla has also exhibited a lot of weakness this year. I'm going to switch over to the NASDAQ 100, and you can see a lot more red than green. Apple has been a bright spot, but I did want to just pull up a chart on Amazon one more time. There we go. That is down 5 days in this chart. It's been down. That would be a 7th day if I'm counting correctly. So some weakness in the mega caps overall, which we can also see in the Mag 7 ETF. And I think that's instructive as well. So the ticker there is MAGS, and we'll see if I can find it on my little screen here. And even if I can't, we've had, there we go. It's down 0.7% today. I'll put a year-to-date chart on there, and you can see how it just broke that support that it held since the beginning of the year. And in fact, that is a 2-month low that we're looking at for the Mag 7. Bitcoin is another sore spot for the risk markets. I'm going to show you a lot of red right there. Bitcoin is down 7.41% over the trailing 24 hours. Ethereum and Ripple, those are each down 10%. But let me just show you the kahuna here. This is Bitcoin. We had a nice, what looked like a base, and you never know if it's a base or a top until it actually happens. But we are now heading down. And the one bright spot for bulls that they can cling to is we have had so many false breakdowns and breakups in Bitcoin, a lot of fake outs. This could just be another one of those. So we'll look for a reversal of this. If it climbs back over 90, 92,000, especially within the next few days, that might just mean this was a temporary washout. And I think that's the best case we can say for the short-term bulls right now. But long-term bulls definitely have the edge, as we can see in this chart. Guys?
Jared, thanks so much teeing up today's trading activity. Appreciate it. Time now for today's strategy session. U.S. stocks struggled to recover from the S&P 500's biggest sell-off this year on Friday. Still, the benchmark index has gone 36 trading sessions without back-to-back drops of 1%. So will the dip buyers return? That's the big question. Joining us now with more, we've got Michael Reinking, who is the New York Stock Exchange Senior Market Strategist. Great to have you back here in studio with us. I was reading your note at the end of last week and talking about some of the flashing warning signs. And I believe you were looking at the S&P 400 mid-cap. Within that, looking at some of the consumer staples as well.
Yes.
Where are there still flashing warning signs that you're tracking?
Yeah, so I mean, over the last couple of weeks, while the S&P 500 was making these marginal new all-time highs, you continued to see the small and mid-cap indices kind of trading pretty poorly. They couldn't actually break above their 50-day moving averages, right? And then one of the things that I like to watch, kind of at these sort of turning points, is the performance of staples versus discretionary, something that Jared was just kind of talking about, right? And you started to see over the last couple of weeks, you started to see staples start to outperform. That actually really, really accelerated at the end of last week, and that's despite the fact that you had Walmart trade down 10%, and that's the biggest component within kind of the staple sector, right? So you've seen kind of this flight to safety. You've seen defensive sectors have really been outperforming. You had the S&P 500 was down almost 2% last week, but yet you had kind of the split between kind of sectors under the surface, right? You had kind of all those defensive sectors that were kind of really outperforming.
Do you see that at all changing or reversing, just depending upon what we get from NVIDIA tomorrow?
It's hard to put it kind of completely on NVIDIA because I think one of the things that, I highlighted that I was watching the mid-cap indices, right? And the mid-cap index is sitting right at its 200-day moving average right now, right? And we've reversed all of those kind of election, kind of all those election gains. I think part of what the market's dealing with a couple different things here, right? We're dealing with a growth scare, as we've seen a lot of the kind of survey data, right, has come in pretty negative, right? We were also seeing negative earnings revisions, right? So we've had a very, very solid quarter, kind of from an earnings perspective. But if you look at, kind of the year, the earnings estimates for the year, right, for the mid-cap index, they're down about, kind of about $10, right, from kind of 205 to the low 190s, right, over since the end of Q3, right? So NVIDIA could help to kind of put a bid back in that Mag 7 and take out some of the concern that we've seen in the unwind of kind of this AI infrastructure trade. If they can kind of convince people that there is still this kind of burgeoning demand, and it could kind of help the S&P 500. But I think for that broadening story to happen, right, we're going to need to kind of work through some of the other issues.
Don't we typically hear companies adjust their earnings forecasts for the year early on in this first reporting period? Why is this time atypical of what we've seen in the past?
Yeah, so I don't think it's necessarily atypical per se. I think that there were very high expectations coming in, right? So we were looking at kind of not only the S&P 500 to show 15% earnings growth rates, but we were also looking at kind of those small and mid-cap indices to show similar growth rates. Those have already been revised down to under 10%, right? And so I think part of what's happening, and this was something we talked about in our earnings preview, is that we would have a solid quarter, but just given the amount of uncertainty, right, that we have from a policy perspective and just an economic perspective, right, management teams are going to be kind of cautious, right? And so you've seen some caution built into those kind of earnings estimates through the back half of the year.
Michael, when it comes to some of that risk-off sentiment, take a look at even just, for example, what's happening in crypto this week. Is there more of a read-through on that? Obviously, some of that being headline-driven with hacks and everything, but beyond that, is that a signal something a bit larger here that's at play?
I think you've had this like very crowded positioning, right? So you've seen kind of the retail crowd, and people have just kind of been moving into these momentum assets, and momentum unwinds happen very, very sharply and aggressively. I don't know that it necessarily kind of signals anything kind of larger outside of a reset, which in theory, in the longer run, can actually be positive. I mean, it's interesting, to go back to Walmart for a second. Like Walmart was up over 50% from the end of Q2 heading into earnings last week. Walmart had become almost a momentum stock in and of itself, right? Where it was this kind of place to kind of move within the market. And you saw those, the numbers were were pretty solid from a quarterly perspective. Their commentary was pretty solid. The guidance was a little bit light. I think there was some caution built into that as well, right? But you saw the stock get hit, by 10%, call it, right? And that was kind of this kind of momentum unwind, and it's just expectations heading in.
We've made it this entire conversation, and we haven't said the Fed or FOMC. What does that tell you about the prioritization in the minds of the market right now?
Right. Well, I will say that, the move that we're seeing in interest rates right now is concerning. For me, right? I mean, it seems like just yesterday that we were talking about, the move higher in Treasury yields, like it was all but, less than a month ago when you had the 10-year was at about 4.8. Right, we've now come in about 50 basis points, and everybody was worried about term premia and inflation concerns. Now we're seeing kind of those growth concerns, kind of start to bubble back up. I would caution, I think, what we're seeing in terms of those growth concerns, they're all coming from the survey data, right? And if you think back over the last couple of years, the survey data also told us that we were going into a recession. Right, multiple times, right? So that survey data has been, negative as things were positive. We're seeing kind of a turn here and some uncertainty. I think that's kind of an expression of uncertainty. But until we start to see the economic data turn, that hard data start to turn, right? I don't necessarily. I wouldn't put too much weight into that survey data.
So you're not too worried then, I guess, about some of the weakness that we've seen?
I mean, there's concern, right? I think the key is, from here, if we do start to get a bounce and we want to see kind of that broadening, like the broadening hasn't happened as investors have hoped in kind of the small and the mid caps, right? It's happened outside of the U.S., throughout the start of the year, with Europe outperforming, kind of pockets of Asia outperforming. When we start, if we can get this bounce, because we're at this key technical level, and we've been down for a couple weeks straight. If we can get a bounce, you want to see how we kind of interact with some of those, kind of shorter moving averages, and see if we can kind of build a base here, kind of for markets to propel higher. I think we have a couple things from Washington that we're, that are kind of top of mind. We have a debt ceiling negotiation. We don't know where Washington policy is. So there is this uncertainty. And we've had kind of the sequencing, which is something we also talked about the last time I was here, right? Thus far, the sequencing has been kind of negative growth, kind of from Washington as opposed to that pro-growth. So if we can kind of move through this piece and then kind of turn the page to some of those more pro-growth policies, that's where we can kind of start to move forward.
All right, Michael, always great to talk to you. Thanks so much.
Thanks for having me.
It's time now for our chart of the day. Let's send it over to Madison Mills. She has a closer look at the moves lower that we've seen more recently in the Mag 7 names. Maddie.
That's exactly right, Shauna. The Magnificent 7 ETF is at a 2-month low this morning. You can see here the Magnificent 7 names falling nearly 9% since their peak back in December. And you can see the last time that the Mag 7 ETF entered near correction territory, which would mean a decline of 10%, was back in August during that sell-off that hit below 15%. So we are inching towards that territory. When you look under the hood, it's really interesting to see which of these 7 names are the biggest movers here. Tesla is the biggest laggard of the group, falling since its December high, followed by Microsoft and Alphabet. As we've continued to mention, given that 20-session streak of Meta, they are the only member of the Mag 7 that's been in the green during this a little bit of a rout. You could say that the Mag 7 names have entered here as they near towards that correction territory. But of course, the focus of the Mag 7 this week is NVIDIA, heading for those earnings on Wednesday. And I saw this stat this morning that really stood out to me. This idea of, pressures on NVIDIA with DeepSeek and cheaper AI has led to a little bit of a sell-off in that name to the tune of $600 billion in the month of January. But we're still seeing investors piling into the stock. $5.7 billion has gone into NVIDIA this year. That is more than double the amount of inflows NVIDIA saw year to date at this time last year. So we're still seeing some bullishness in the stock. The stock has 90% buy rating from Wall Street. If you take a look at the analyst recommendations on Bloomberg, of course, we will continue to monitor NVIDIA and the rest of the Mag 7 as we head into that key chip giant earnings tomorrow, guys.
Key critical report. Can't wait. Maddie, thank you so much. Appreciate it. Coming up, everyone, a disappointing quarter for Krispy Kreme, the key crispy trade here, how the donut chain plans to turn it around this year. CEO Josh Charlesworth joins us next. You see him there, hear him in a moment. Next on the Morning Brief.
Krispy Kreme plunging after missing Wall Street expectations for the fourth quarter, also issuing weaker than expected guidance. You're now looking at losses of just about 22% for the stock. The donut chain's revenue falling 10% from a year ago. Part of that was driven by a hit by a cyber attack in November that disrupted online ordering. So here to tell us more about the road ahead, we want to bring in Josh Charlesworth. He's the CEO of Krispy Kreme, also joined by Yahoo Finance's Brooke DePalma. It's great to have you both. Josh, when you take a look at the stock's reaction to this, clearly the street very much focused on the miss that we saw the most recent quarter, also the guidance though that we are getting for the quarters ahead. What is your message to the street here this morning, given the magnitude of the drop?
Yeah, good morning. Thanks for having me on. This morning we did report our 18th consecutive organic growth quarter. That was actually in line with our expectations, excluding the very disruptive cyber incident we had last year. And then, yes, indeed, we talked about the key messages for this year are about transforming the business into a bigger and a better Krispy Kreme. Our core strategy is working, which is to get those awesome fresh donuts out to more people. And we really focused on the milestones we achieved in 2024 and 2025 to do that in the US through national distribution partners and internationally with franchise partners.
Josh, weather did cause a choppy start to the year. We're also seeing that pair with the value-conscious consumer moving into the year. How do you boost investor confidence right now?
Well, the first thing I'll say is, that strategic focus areas that I already mentioned, such as expanding with national partners in the US, that's continued to grow very well. We achieved a milestone of $250 million of revenue last year, over 20% growth. So that's where we're taking the donuts to people, making it more convenient for people to buy our donuts. What you're referring to, the choppy start to the year, is in our traditional retail shops, where we have seen the value-conscious consumer also pressured. What's great is we've got the beloved original glazed donut. It's our most affordable donut, and we're bringing everyday value to our customers with that. So, the strategy's working. It's a choppy start to the year, but as we prepare for this national rollout in the US and indeed international expansion, we're confident for the long-term profitable growth.
Josh, all due respect, the stock's at an all-time low here today. How do you essentially believe that the strategy is going to translate through to shareholder value?
Well, our focus is on getting the best out of the of this profitable model that we've already established. But we're in a change phase right now. We're investing ahead of achieving that national rollout. We are expanding with national partners like McDonald's. We added Target last year. We announced this morning we're adding Costco. What's important is, as we build out from being a regional player in the US to being a truly national player, we need to make sure we do it in a sustainable, streamlined way. As you can imagine, just selling the donuts out of the front of the shop versus actually running a more sophisticated food distribution system means that we need to go through change. We need to transform so it's sustainable long-term growth. And that's our focus today. We also announced on the international side, looking at international franchise partners, and that news today also we know will bring shareholder value to your question.
I'm glad that you brought that up, because I also highlighted that in my notes here. You said that you've begun that process to evaluate refranchising certain international markets, essentially when companies sell corporate-owned stores to franchise partners there, or franchisors, or franchisees rather. Which geographies specifically are you targeting in the rollout of that?
Well, for that, we're focused on international. It's incredible. Krispy Kreme, actually, from a system-wide sales point of view, is as big internationally as it is in the US. And we're in 40 countries around the world, largely with franchise partners. But we do have some markets that we are company-owned, UK, Ireland, Australia, New Zealand, Japan, Canada, and Mexico, where we think that going forward, the fastest way to grow, the most capital-efficient way to grow, is to do it with national partners like we've seen in those other international markets.
Josh, some of the commentary that you mentioned on the call, one of the things that stuck out to me was the fact that you called it choppy right now, just in terms of the sales so far this year. You talked about the weakening consumer spending. How much of that, in your view, is a result of inflation?
You know, most of where we've seen that is in the traditional retail outlets, and indeed back in 23, we did take pricing on our donuts. Initially, we didn't see an impact. So, you know, more broadly, obviously, the value-conscious consumer is under pressure right now. Interestingly, where we're bringing the donuts to people rather than having people come to them, where we're putting those awesome fresh donuts right in front of them by the checkout in Walmart, now Target, or indeed a McDonald's. We just launched in McDonald's today. You know, where we're bringing the donuts to them, we're not seeing the same impact.
In terms of that partnership with McDonald's, what is the price point difference between what you sell at a Krispy Kreme store versus what you're selling at these partners? And what does volume look like? And do you plan to close more underperforming and really invest in these partnerships more so?
This McDonald's partnership is an exciting one. We've already got, even though we just started in October, to 2,500 restaurants, and we know the feedback from McDonald's has been positive. We're now looking to roll out to 6,000, indeed 6,000 by the end of this year, indeed 12,000 by the end of next year. So it's an important program for our growth. The donuts are freshly made. They are delivered daily from our hub and spoke network. So they're very similar to what you get in a Krispy Kreme store, but not the same variety. The price points are not dissimilar from what you would get at our donut shop, but at our donut shop, you get some of our latest specialty collections as well. So there's some variation there, but it's all in the strategy of just bringing donuts to more people.
Josh, Brooke, you managed to do it. My stomach's officially growling. I appreciate it. Thanks so much.
You bet.
On the other side of the break, more trending tickers on the Yahoo Finance site. Those stories next when Morning Brief returns. We're taking a closer look at some trending tickers this morning. Let's go. Eli Lilly cutting prices for its blockbuster obesity drug Zepbound as consumers flock to cheaper alternatives. Lilly also announcing the launch of the 7.5 and 10 milligram single dose vials.
Plus, Keurig Dr. Pepper rising after a top and bottom line beat in the fourth quarter, sales climbing as the company sold more products at higher prices. Areas that missed estimates include coffee sales and international sales.
Finally, Zoom falling on a weaker than expected outlook for 2026. Video conferencing platform just missing revenue estimates for the full year. Operating income barely meeting expectations.
All right, well, that does it for Morning Brief. Keep it right here. Catalyst coming up next. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. We're 30 minutes into the U.S. trading day. Let's get you the three catalysts that we're watching this hour.
First up, a risk-off shift in the market as the 10-year yield hits a low for the year and the tech-heavy NASDAQ continues to fall.
Plus, the latest consumer confidence data crossing the wire, what the numbers tell us about inflation expectations.
And Bitcoin sinking to a 3-month low. We will unpack what's driving those declines right here on Catalysts. We're getting a preliminary reading on consumer confidence in February, dropping sharply here. You've got the survey anticipating 102, but the number coming in stiffly below that at 98.3 and also below the prior reading of 104.1 here. So interesting to see that level of a decline here. Again, that consumer confidence number coming in below the survey number, which was 102, the actual number coming in at 98. Conference board expectations also also falling, coming in at 72.9. So we're going to continue to break down those numbers as we get them here. Joining us now, we've got Elena Shaletyeva, the Conference Board's senior U.S. economist. Elena, I'm still waiting for all of the data to drop in, but what else can you tell us?
Well, I think it was a sharp drop, no doubt about that. And now the index is at the lowest level of the range it has been hovering over the last several years. Having said that, I think the index is still within the range, which is associated with healthy consumer spending. Although the decline in expectations is definitely a concern and deserves close watching.
When you say it's a concern, I guess at what point should we be a bit more worried? And what is that range that would then drop below that we would then, I guess, would raise some of those concerns?
I think this particular survey from the Conference Board is telling us a lot about the state of the labor market. And this particular decline in the confidence indicator was driven by consumers' expectations for business conditions and the labor market. So what is a concern is that consumers are not seeing great prospects in the labor market, and that is something to watch in the months ahead. If that continues to deteriorate, that's a big deal.
But it also looks like inflation expectations ticked up. Median inflation expectations coming in at 4.8%, following 4.2% the prior month. How concerning is that?
Consumers are worried about inflation. Inflation is sticky, and the latest developments in terms of, I would even say, some certain consumer goods such as eggs, that could be driving it, and also the talk about tariffs. So we know that next week, the next round of tariffs is probably going into effect, and consumers hear this news and they are very concerned about this. So everybody is talking about inflation rising on the back of tariffs, and that is a great concern for the consumer.
Yeah, I'm taking a look at this release here. It looks like that the decline was across all age groups, also was pretty broad-based among income groups. What's your takeaway from that, just the fact that we are seeing some of that concern really just across the board?
That is a concern. We know that consumer spending has been in a large part driven by those at the top of the income spectrum. So those more affluent consumers who have assets on their hands, they are, they hold stocks, they have property, real estate property, they have been driving consumer spending. But the fact that it's a decline across the income spectrum and age groups is a concern, because that's our consumer spending, and if this is going to slow down significantly, that's a concern for the economy.
It's interesting, though, in this note, in the survey data here, looking at a 6-month average basis, purchasing plans for homes continued to recover. I wouldn't have expected that based on what you just said, that all income groups are feeling a little bit more negatively about the economy. Where is that recovery in housing coming from?
I don't expect the recovery in housing this year. Rates are still elevated. The affordability is still pretty low given where the prices are. We actually have a drawback from the residential investment sector in our projections for the economy for this year. So I think, until we see a more significant decline in long-term rates or, deceleration in price increases for housing, we will probably not see a significant improvement in the sector.
What are you hearing just in terms of the fact that we could be in this high for longer environment, and how much pressure that could potentially put not only on the sentiment side of things, but obviously that hard data too?
So I think, what we expect for the economy is deceleration this year. So we are coming from this high growth that we saw post-pandemic. So that process is continuing. So we saw some pickup in consumer spending over the turn of the year, and probably that was driven by consumers trying to stock up ahead of tariffs, and businesses too. Now that that has already happened, I think we were going to continue to slow down towards the end of the year. My concern is the labor market. If it slows down significantly, that would pull things quite significantly below what we expect.
So how are you thinking about the divergent policy impact on the labor market? Obviously, we're seeing cost cutting leading to a lot of layoffs for federal workers, but then you have news like Apple adding 20,000 jobs to the US. Do you think that these US companies adding jobs could offset some of those concerns?
For now, we're like at a very happy equilibrium, right? So we're not adding too many jobs, but we're also not cutting. There are no layoffs. So it could go either way, right? Depending on how businesses are feeling. So we had another survey earlier last week that showed business optimism was rising quite significantly. So which way will it go? We don't really know. And for now, businesses feel optimistic, and they are expected to hire people. But at the same time, if tariffs have a significant impact on economic growth and our expectations that it could potentially cut up to 1 percentage points from growth this year, if what has been announced is implemented, then we're probably going to have a different story.
All right, Yelena, great to have you. Thanks so much for joining us.
My
here on
pleasure.
Set. Let's take a look at a trending ticker here this morning, and that is Home Depot, the company issuing a conservative same-store sales forecast for the year as it expects consumers could potentially hold off on some of those larger purchases. But the focus on the street, the reason why we're seeing the stock up nearly 3% here in early trading, much of that has to do with the stronger than expected quarter, the fact that same-store sales did snap 8 consecutive quarters of declines, actually rising 0.8% from a year ago. Joining us now to discuss is Michael Baker. He's D.A. Davidson's senior research analyst. Michael, it looks like the street at least looking at the more optimistic side of this report. I think the big question is whether or not some of the improvement that we saw in same-store sales, whether or not there's enough momentum for that to continue. What do you think?
Yeah, I think the strength in the fourth quarter is really what is carrying the day here. The 2025 outlook was below consensus, particularly on the earnings side, a little bit more so than on the sales side. Both were below, but I think the real pressure point was the earnings. But it's pretty clear, I think, from the call and from what we know about retailers in general, that companies want to sort of set a lower bar. That doesn't mean they're sandbagging it. January was a softer month than December, so they did see a little bit of a slowdown. That plays into the guidance. But I think the bigger idea is let's just set a low bar, something that we're comfortable with, given all the uncertainty in the environment, all the policy rifts, as we call them, our acronym, for rates, inflation, FX, and tariffs. It makes sense to set a low bar. But clearly the business seems to have bottomed, given what we saw in the fourth quarter in a number of metrics the company talked about on the call. Big ticket spending, et cetera.
Well, it's interesting, though, because the CFO did mention that they're still facing pressure as customers adjust to high interest rates. How concerned are you about the headwind that could present, especially if the Fed does not continue to cut rates?
Sure, that's a pressure point, but it's a pressure point that's not getting any worse, right? We've been dealing with that for quite some time. In fact, rates don't seem to be going up anymore. They're down 30 basis points or so on the 10-year in the last month. Home Depot gives a metric on comp sales for tickets $1,000 or higher. That was positive this quarter. That's the first time that's been positive for more than 2 years. It had been down 5-6% every quarter. So there's still some pressure on these interest rate sensitive businesses, but again, no worse so than it has been, and maybe even getting a little bit less worse.
Michael, one of the questions going into this report was the impact of tariffs and the threat of tariffs, maybe what that could do ultimately to Home Depot's business in the longer term. Where do you stand on that, just the broader implications of it?
Yeah, to me, tariffs are a relative game, right? It's all a function on how much of your COGS come from overseas, and then your ability to push back on vendors or pass through to consumers. And we think within that sort of dynamic, Home Depot is pretty well positioned, particularly as it relates to pushing back on vendors. That's all about scale. Home Depot pushes a big pencil. Their vendors want to keep that Home Depot business. That doesn't mean the vendors will eat it all and Home Depot won't absorb any. But within that sort of negotiation dynamic, Home Depot is pretty well positioned in our mind.
So it doesn't sound like it's too big of a concern, but I guess how big of an impact is it going to have on their business?
Well, again, if anything, we think it'll tend to be maybe slightly positive, because we do think they'll be able to pass some of it through to consumers. That's what we saw last time there were tariffs in 2018-19. So maybe even a little bit of a comp benefit. Now, the offset could be, do you lose units? But that's not really what we saw last time. So listen, we don't want to dismiss it. We do think it could have some impact, but they will be, particularly on the margin side, but they will be impacted less than others. And again, it could actually be a helpful item to the comp line.
One of the concerns from a macro level is this idea of a K-shaped recovery, and that lower income consumers will potentially be more negatively impacted by the policy shifts of things like tariffs versus higher income consumers that have a little bit more on their balance sheet to protect them from any inflationary pressures. How does a company like Home Depot potentially get impacted by a K-shaped recovery if we do start to see those middle and lower income consumers struggling even more?
Yeah, Home Depot does skew more towards higher household income customers just by virtue of the fact that you're a homeowner. So that kind of dynamic, while unfortunate for the lower end customers, it really does play well for Home Depot, which again, more of their customers are in that middle to higher income demographic.
Michael, who's best positioned within this coverage space right now to you here over the next couple of quarters?
Well, we like Walmart, particularly on the pullback after last week's report. We like other discounters like BJ's and Costco, but BJ's better just given the lower valuation. When I say other discounters, we don't love the dollar stores, but BJ's and Walmart within the discount space. And then I think there's an opportunity here at Home Depot. We upgraded it last year. We knew we'd be a little bit early as it relates to the housing recovery, but housing's not getting worse here. In fact, existing home sales have been up on a year-over-year basis 4 months in a row. So again, we think we're in front of the recovery, but that's really when you want to buy stocks in front of the recovery. So we think we're there now.
All right, Michael, always great to talk to you. Thanks so much for hopping on with us here today.
Sure.
Coming up, we're going to take a closer look at some of this morning's trending tickers, including why shares of Supermicro are off just about 8% right now. We'll be right back. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. First up, shares of Japanese trading houses rallying following Warren Buffett's plans to increase its holdings in 5 Japanese trading houses. Now, Buffett praised Japan's trading firms for their business practices, including increasing dividends, conducting share buybacks. He also said that his holdings of the 5 companies are for the very long term. We're looking at the reaction here in the stocks today. The market was closed overseas yesterday because of a holiday, so we're seeing that play out from the news that we got over the weekend here this morning. Now, when it comes to the opportunity here that he does see in some of these names, especially in Mitsubishi, we know that Buffett first showed interest in them back in July of 2019, but he has been very consistent just in terms of his praise. This is very much a follow-through of some of that rhetoric here that we have heard over the last several years.
Yeah, and it's played out in the ADRs here. If we can take a look at the performance of these trading houses versus the index over in Japan, the Nikkei 25 here, you can see the outperformance of all of these trading houses versus the Nikkei, which is going to be the bottom line on your screen there. So clearly a successful bet for Warren Buffett so far. It was also interesting in that Berkshire annual letter. He talked about how these trading houses did agree to relax the ceiling on Berkshire holdings, which had been at 10%. They're relaxing that, so they're going to be able to own a little bit more. I wasn't able to see clarification on exactly how much more they're interested in moving forward. But lastly, I'll just add, I thought it was interesting the specific pros that Buffett put forward for these trading houses. He talked about how he likes their dividends, they conduct share buybacks when it is sensible, and he also liked that they are not as aggressive in their executive pay as U.S. companies are, which I thought was interesting, a little bit of shade thrown towards the U.S. companies that are maybe overpaying their executives.
Yeah, what was also interesting was just some of the commentary just surrounding currencies, right? And just in terms of the fact that he was, once again, just very confident in their yen balance strategy, what he described as a yen balance strategy. He also went on to say that that he and Greg both have no view on future FX rates here, and therefore do seek a position that's approximately currency neutrality here. So again, I think that's important to keep in mind, especially when you go back to some of the volatility that we saw over this past summer.
Yeah, really great point, Shauna. All right, well, we are also going to talk about shares of Supermicro falling ahead of its deadline for already delayed financial results. In an earlier update this month, Supermicro had said that it did expect to meet today's deadline. If the company does not deliver, though, it risks being delisted from the NASDAQ. So let's just do a little rewind in time. Remember, Supermicro, they delayed their financials for the fiscal year ending in June 30th. They delayed that to September 30th, and now they've delayed it again, and the deadline is finally here. If they do not comply again, they could be at risk of being delisted from the NASDAQ. It was the most volatile stock in the S&P 500 last year, in part due to these concerns, the company losing access to their auditor, the auditor dropping SMCI, but they say an investigation did find no evidence of fraud. And we've also seen a huge run up in the stock, of course, following their announcement that they are expecting $40 billion in revenue for 2026. But that volatile story is still continuing.
Yeah, a lot of it just hinges on whether or not, I mean, again, you can only take what they have said at face value. They said that they are going to meet this deadline as of today. The fact that the clock is ticking, obviously, the shares are off and under a bit of pressure here, off just about 8%. Again, when you go back to the guidance that we did get earlier this month, that long-term revenue outlook, the fact that they did pledge to once again meet that NASDAQ deadline, that did alleviate some of those concerns. You can see it reflected in the share price to the right-hand side of the screen right now. But again, still lots of questions about whether or not, one, they are going to meet this deadline, but then two, just beyond that, fundamentals of the business. Obviously, there's a lot of outstanding questions there as well.
Lots of questions.
Let's take a look at Tesla. Tesla's market cap falling just below the $1 trillion market. Shares do face some pressure, which comes as its European sales hit a 2-year low. You're looking at today's drop of just about 7%. So talk about the significance of this. We certainly have seen this risk-off sentiment. Many of these Mag 7 companies have been caught up in some of that selling pressure here. You're looking at Tesla here lead to the downside. It's actually the biggest laggard in the index during the drawdown that we have seen from the December high level. So again, we have seen this continuation of selling here right now, falling below that $1 trillion market cap. Lots of questions about what it's going to take in order to reverse some of that momentum, obviously beyond just Tesla, beyond and into some of those larger tech giants and some of the more broader selling that we have been seeing. But again, Tesla under a bit of pressure, of course, putting into context after the massive run-up that we saw following the election.
Yeah, that's a really great point, though. Tesla being the loss leader today does officially put the Magnificent Seven into correction territory as of this morning. And a reminder, correction territory is when a stock or an ETF, an index, is down by 10%. So that's what's happening with the Mag 7 ETF right now. But the big question, I think, is how much of this is due to Elon Musk's politics impacting his sales in Europe. I think it's interesting context. They had a 1% market share in Europe in January. That was down from just 1.8% this month last year. So not that huge of a drop off, but when you compare it to some competitors, especially the Chinese EV giants, they had a lot of success in January. So it points to this kind of comparison game and whether or not the competitors are able to take up more market share given Musk's continued focus on some far-right politicians in Europe. And maybe that is starting to weigh on those sales. Again, BYD in particular outselling Tesla in the UK for the first time ever for the month of January here. Well, AI heavyweight NVIDIA is set to report results after the close on Wednesday. For those thinking of buying the stock before earnings, we've got to look at what your return could look like based on past performance. Here with the breakdown, markets and data editor and host of Stocks in Translation, Jared Blickery. Hey, Jared.
Hey, Maddie. Well, we've been talking about the breakdown in the Mag 7, and let's talk about the poster child, NVIDIA, down 10% for the year, and we are just showing a year-to-date chart. This is frustrating for traders, but we've seen this before, and a lot of times the earnings has been a catalyst for both the bulls and the bears. So let's break down the earnings reactions over time. I'm going to go back 10 years here, and I'm looking at the average and median returns of various time frames after the report. So here's one day. You can see a median result of 3.4% to the upside. For 1 week later, it's a median of 4.3%, and for 1 month, pretty much sticking within this range, also 3.4%. And you can see the percentage positive going pretty sideways as well, 63, 68, 60. Anything less than a 70, I don't really think is too bullish, just because US stocks tend to go up. But it gets interesting. 1 quarter out, we see the average or median returns up 17.5%, and then the percent positive goes up to 74%. But the real magic happens if you're holding for a longer period of time. 1 year returns tend to be 112%. That is a huge amount, basically doubling over a year. And this goes back 10 years, let's remember. And then the percentage positive shoots up to 84%. Very strong results there. But I've seen many times over the last few years, especially within the pandemic or post-pandemic, the tendency has been, and there's been a few examples of this, for the earnings reaction to be suddenly reversed. So there have been times when it jumps up to a new high. The next day, everybody gets excited, loads up even more, and then it only crashes down. So I think that dynamic is kind of what we're looking at right here. So the message for traders is probably want to be a long-term holder unless you're extremely adept at navigating these short-term vicissitudes. Now, I want to get into the weeds a little bit by looking at options implied volatility. This is a very simple concept. Measures investors' expectations of future price swings based on options prices. So we look at the options market, and those traders' opinions are being reflected in that, and we come up with some numbers here. The options implied volatility for the 1 day after the announcement is 8.5%. Now, the prior 2.5-year average here in the actual reaction was a bit higher, 11.1%. So options traders are not expecting as big a reaction actually as we have seen historically, just based on this metric. And then we have the average daily movement since the last earnings, excluding that earnings day. So if you take out the big day after earnings reaction, you only see volatility of about 4.3%. So the bottom line is we can expect a doubling or even a tripling. That would be nothing. That would be no sweat for NVIDIA on Thursday. And that's the earnings reaction day that we want to pay attention to. So you wrap it all up. We have something for the short-term traders and the long-term traders here, but the long-term traders definitely have it a lot easier, at least with respect to NVIDIA.
All right, Jared, thanks so much. And of course, we're going to have coverage of the every move that we're seeing in the stock's reaction following those results on Wednesday after the bell. And then, of course, with us as we kick off our opening bell coverage on Thursday morning. Jared, thanks. Coming up, crypto sentiment sinking, Bitcoin hitting its lowest level in about 3 months. What's next for the crypto industry? That's coming up when we come back.
And I think we're happy to put that behind us. I think that there's so much to be built that at the end of the day, we'd rather not engage in litigation, particularly when we think that it's not well-founded and not based on anything real and just a general kind of attack on the industry.
Bitcoin falling below $90,000, hitting its lowest level since November. This comes after hackers drained $1.5 billion in digital assets from the exchange Bybit, and what researchers are dubbing the largest crypto hack of all time. Joining us now to discuss, Noel Aitchison, Crypto is Macro Now founder and author. Noel, thank you for being here. So how much of this is about the Bybit hack versus general macro concerns driving the sell-off?
It's easy to guess, it's easy to assume that this is the delayed reaction to the Bybit hack, but I don't think so. The Bybit hack was awful, but it was handled really well. And what's more, by Monday morning, the hole had been filled. Over the weekend, the industry showed that it is maturing, that it is transparent, and that it can come together in times of crisis. Not to belittle what happened, it was awful, but I think it was very much isolated to the crypto community and it was digested. I think what we're seeing now in the crypto markets is an extension of what we're seeing in macro markets. We're heading into risk-off territory, and crypto, being high beta assets, are reflecting that and then some.
So then, Noel, what does that then tell us just about some of that downside maybe that we could still see here in the move with crypto?
Crypto is going to be slightly more volatile than traditional assets, but it could go lower. To be honest, this is something we've sort of been expecting. Crypto, I'll take Bitcoin as the bellwether here. It has been trading more or less sideways since the November rally. And so we've all been waiting, is it going to break up or is it going to break down? It has to break in some direction at some time. And given the clouds gathering on the macro horizon, growing consensus was it was going to break down at some stage. When? We didn't know. Maybe that's what we're seeing now. But what we're seeing is not just growing concern about U.S. economic growth. I mean, that's pushing bond yields down. That's pushing the DXY down. That should be good for risk assets, all else equal. But we're also seeing concerns about geopolitical fractures. And let's face it, the Trump rally could be just getting exhausted here. It could be some fatigue we're seeing setting in. I mean, let's face it, the past few weeks have been exhausting. Add to that, throw in some skepticism that the Doge cuts will actually make a dent in the deficit, and things feel particularly fragile now. So when you are talking about assets that can behave either as risk assets or safe havens, depending on the mood, then everything that can be sold will be sold.
So Noelle, I guess that begs the question, is there anything on the horizon that's going to change then this downward momentum?
Yes, then I would say that's simply price. We know that, and this is one of the advantages that an asset such as Bitcoin, again, to pick the bellwether crypto asset, is one of the advantages of its multi-narrative characteristics. It is a risk asset, and so we'll head down with other risk assets when that's the mood, but it is also a safe haven. It is very much like digital gold. This is a narrative that BlackRock and many others have been pushing out there, and many investors do see it as that. So when it gets to a lower price, those that have been sitting on the sidelines waiting for opportunity will step in. Its floor is going to be higher than other assets that didn't have that diversity of narratives. And let's face it, if ever a safe haven was needed in diversified portfolios, arguably it would be now.
So basically an unknown low level is going to be the next catalyst for upside momentum in digital assets?
True. And when I say unknown, I'm not a technical analyst, but many of my colleagues in the industry are. And because it is a sentiment-based move generally, they do tend to hold some weight. And 80 is the next number that people are talking about. It could go that low. But again, we don't really know, because all it would take is for the selling to get exhausted. I'm often asked, Maddie, whether, what's the catalyst? What are we waiting for to get the bull market going again? And the answer is always when the sellers get exhausted. And often what it takes for that to happen is a short, sharp correction like this. It's a thin market. When things are moving fast, people do tend to, step back and let the liquidity providers do what they're going to do and let the short-term traders do what they're going to do. But this will find a floor eventually. I have no idea how low it'll go, but I would bet not as low as many would fear.
And it's interesting in the context of this administration, which of course has been viewed as very pro-crypto, and we've seen the SEC dropping their lawsuits against Coinbase and Robinhood in recent weeks. I was a little bit surprised that those events weren't a bigger catalyst for Bitcoin to the upside. Can you walk me through that?
Absolutely. You raise a really good point. The tailwinds for crypto markets have been building. So many of its obstacles have been being removed. So everything has been setting up the crypto asset, especially the prices of the bellwethers, for a very positive run that hasn't been happening, which has led many to say, is this over? The mood has been bleak in the crypto market recently, and partly it's because we haven't been getting the rally that we expected with the regulatory thaw. But I do believe that is because we're not yet seeing the new money come in. And we all know that bull runs are always driven by new money coming in. The new money we're waiting for is from the large institutions who are having the path cleared for them to do so, with the large custodians gearing up to offer services, with the ETFs already on board. However, they take their time. They're not necessarily going to be moved by short-term considerations. They have a lot of boxes to check, a lot of people to convince. And a drop like this could incentivize them to start to come in, but they were always going to be slow but methodical and careful. When we do see them come in, then we will see the move. Until then, the headlines that we're getting, the positive move, the positive noise from Washington, D.C., that is just building the tailwinds. It's not necessarily going to move the price until the new money does start to step in.
Yeah, that makes a lot of sense. So I hear you noting that it's this digital safe haven, but also a risky asset. Help our investors understand how they should be strategically thinking about portfolio allocation when it comes to crypto, given that it holds both those titles, a safe haven and a risk asset.
That is such an excellent question, and it also highlights how confusing this asset group can be to many people. I often get asked, what is Bitcoin? And my answer is it's what you want it to be. If you want it to be a risk asset, then it's a risk asset for you, and you will trade it as such. If you want it to be a long-term holding, a safe haven, a diversifier, much like digital gold, then that's what it will be for your portfolio as well. In the end, it comes down to timeframes. If you're thinking short-term, crypto is volatile. How can such a volatile asset be a safe haven? Long term, it is, because it resists the dilution that we're seeing in most others. So that's the easy answer. It can be both according to different timeframes, and that adds a certain fascinating complexity to the narrative behind it. It gives it a higher floor than other assets, and it also leads to some very interesting philosophical questions. How can an asset be so many different things at the same time?
All right, Noelle, always great to talk to you. Thanks so much for making the time to join us.
Thank you so much.
Well, the selling continuing today in the broader market. You've got the S&P extending its decline, hitting the lowest level that we've seen since January 15th. Now, despite the drop and the recent move to the downside that we've seen, some on Wall Street seeing a few catalysts on the horizon. Here with more is Yahoo Finance's Alexandra Canal. Ali, give us some reasons to be optimistic.
Yeah, it's a lot of pessimism on Wall Street right now after this consumer confidence reading. We had the sentiment reading on Friday, but there are some catalysts, especially in the near term, that could drive stocks higher. And if we think about the sell-off that we saw last week, there was a confluence of different factors there. We saw Walmart's soft guidance that led to some concerns about the state of the U.S. consumer. We had Microsoft's decision to cancel some leases for data center capacity. But as we look in the week ahead, NVIDIA earnings on Wednesday, that's something to look forward to, especially since a lot of those big tech names, in particular the Mag 7 names, they've underperformed the broader market here. Now, most on Wall Street do expect NVIDIA to outperform this earnings. The options market, it's implying a 7% gain or loss. That's significantly less than what we've seen over the past 2 years, but it remains to be seen. If we get solid results from NVIDIA, that's likely to make the Mag 7 enjoy some gains. So perhaps the Lag 7 can now be the Mag 7 once again. There's also the fact that we have this expectation that inflation is going to continue this deceleration. We did have that hot CPI print, but there were components within that consumer price index that feed into the PCE inflation data. That's the Fed's preferred inflation measure. And that actually showed some softness there. So, and if we get that better than expected inflation report on Friday, another potential boon to stocks. And then finally, the Fed outlook. Yes, we have these risk factors that have been wandering around the market, and perhaps that convinces the Fed to cut rates sooner rather than later. We see that the odds for a May cut, that's actually doubled over the past few weeks. We're still at a pretty low level, just around 20-25%. But if we get a further deterioration of the labor market, if we see that GDP data that's due on Thursday come in a little softer than expected, perhaps the Fed can recalibrate its rate cut thinking. And obviously markets would love to see some rate cuts at some point this year. We did hear from Bank of America earlier today saying that they don't anticipate any rate cuts in 2025 or into early next year, but we just don't know. And all of that could be a potential tailwind for some of these market moves.
And it's really interesting given there was so much optimism about the incoming administration and the market rally that would come off the back of that. And then you had Michael Hartnett from Bank of America this morning saying that the market still is a red light for the Trump administration. I wonder, Ali, when you think about the conversations you have with sources and just your outlook for the market this year, how much momentum and optimism do we have? How much potential do we have to move to the upside given all the question marks about policy right now?
Well, look, markets don't like uncertainty. And I think in particular, when we think about the tariff conversation, we just don't know. I mean, Trump has gone back and forth when it comes to those tariffs on Canada and Mexico. He revived those threats the other day, which is part of the reason why we're seeing some markets sell off. But by and large, Wall Street analysts do see upside ahead. Citi sees the S&P ending the year at 6,500. That implies upside of about 10% based on current levels. So they have warned that between now and then, there's going to be some choppiness. There's going to be some volatility. You have to be patient within this market, especially since we do have valuations that are so high. And Hartnett was also talking about the fact that we're seeing a lot of inflows into overseas markets and how that could potentially signal some trouble ahead in the U.S. But it seems like by and large, Wall Street is still bullish on the long-term outlook for stocks. You just have to be able to weather some of that volatility in the interim, which we know investors don't always like it, especially when we've been used to such massive gains the past 2 years of this bull market.
Yeah, exactly. Those double-digit gains getting us very spoiled. Ali, thank you so much for joining us and breaking that down. We appreciate it. Coming up, Apple preparing for shareholder meeting showdown over its DEI policies. We'll have the details for you next.
Apple investors are set for a decisive vote at the company's shareholder meeting today with DEI on the agenda. Here with the details, senior legal reporter Alexis Keenan. Alexis, what can we expect later today?
Yeah, so at about 11 o'clock Eastern time, the shareholders meeting will get underway, at which we're expecting this proposal to get a vote. And it's a proposal from a conservative think tank called the National Center for Public Policy Research that has been pushing for some changes to DEI efforts across U.S. corporations. And what they're asking here from Apple is to consider abolishing its DEI efforts, so diversity, equity, and inclusion efforts. Apple is opposed to this measure. The shareholders, for their part, what they're claiming is that DEI now in 2025 and also in 2024 too, arguably, poses financial risks, legal risks, also reputational risks to companies. Why? Because in 2023, there was a Supreme Court decision that outlawed using race as a factor in university admission decisions. On top of that, you had another Supreme Court case that has made it in 2024 easier for employees to go after their employers to sue them for discrimination claims. So those two things, these shareholders say, walking into Apple and saying, well, we need to vote on this, we need to reconsider. And that's what is is happening across corporate America, a lot of these pushes to end these DEI initiatives. So on top of that, you also had an executive order from President Trump on his first day in office saying that he wants to end the federal DEI initiatives, also warning private businesses that they should end what he called illegal DEI efforts. And especially for federal contractors, that kind of raises a flag for them, and Apple is a federal contractor. And the reason is because federal contractors have to do a certification that they don't have any illegal DEI efforts ongoing within their walls. So a lot to consider. The same think tank also submitted anti-DEI proposals at JP Morgan, also at Goldman Sachs as well.
How is this impacting those other companies then, especially when you consider what you were saying about those federal contracts? Are there other companies you've been tracking that have significant federal contracts that could make them, I guess, more susceptible to any shifts from the Trump administration on DEI changes?
So there's a legal argument ongoing as to whether the executive order, whether any of this really plays into the private sector, right? There are plenty of attorneys who will get up and argue, well, no, none of this impacts private enterprise. They can do what they want, make their own decisions on diversity, equity, and inclusion. But we have at Yahoo Finance been trying to track some of these companies. You can see there on your screen, you have a lot of companies that are going ahead and putting in their heels, sticking with their initiatives, Apple, Coke, Microsoft, Costco, to name some there. You see Delta also. And then on the other hand, the companies that are pivoting, that are shying away from their DEI programs, Google, Meta, Goldman Sachs, Citigroup, Target, Walmart, Amazon, there are more. You can check it out online. We've been trying to track these changes as closely as possible.
All right, Alexis, well, thank you for your reporting on that, and we will continue to monitor what happens with this Apple meeting later today and talk to you about that as well. Thank you. Coming up, we're talking with the CFO of Amer Sports about tariffs and the health of the consumer. That conversation next. Shares of Amer Sports, parent company of Arc'teryx and Wilson, are under some pressure this morning after the company reported its latest results. The company expecting unfavorable exchange rates to weigh on sales growth in 2025. Joining us now, Andrew Page, Amer Sports Chief Financial Officer. Andrew, great to have you on here. So lower sales growth and the revenue growth outlook for 2025 are weaker than expected. What do you think is driving that pressure?
As you talk about 2025, I think about 2024. We had an amazing year. We exited 2024 with really, really strong sales growth, up 18%, paid off about $2.5 billion of revenue, strengthened our balance sheet, reduced our effective tax rate, reduced our leverage ratio, and then exited 2024 with momentum. As you think about the underlying business next year, our guide, which speaks to reported currency on a constant currency basis, would reflect about a 15 to 19% growth on a constant currency base. So exiting 2024, the business is strong. Entering 2025 is healthy, and our constant currency growth rate is in line with 2024.
Andrew, you're starting to see any sort of weakening trends, though, within the U.S., and I just bring that up because the growth numbers that you posted in the Greater China region were staggering, just across Asia Pacific in general, and then you compare it to what we saw in the Americas, where it did grow 15%, but that pales in comparison to some of those growth rates that you're seeing overseas. I guess, what do you attribute that to?
I attribute it to the maturity of the market. So we have been, Wilson, which is a predominantly U.S.-based business, has been doing business for 114 years. Arc'teryx, Solomon, they are just entering in the last 5 years some of those markets where you see the outstanding growth rates. And so as those markets mature, they started from a much smaller base, and we're excited about the growth across all of our markets. You mentioned the growth in APAC and Greater China approaching 50%, and in the Americas and EMEA, really strong growth as well. And so as our markets mature, we like the fact that we have a very global distribution of revenue. We operate across all four of those major markets, and we're excited about where the business is growing and the even distribution of our revenue.
I hear you saying you're excited about the globalization of the business, and I think that's interesting in the context of tariff policies that a lot of the executives we speak with are concerned about for 2025. How are you positioning and strategically thinking about the potential impact of tariffs on your business?
Well, I think about the fact that because of the global nature of our business, we are about a third from a revenue distribution between North America, EMEA, and Asia. And that is a benefit to us. We benefit from having a distributed revenue base. As a result of that, we also have a number of levers that we can pull because of our premium positioning of our products. We obviously have pricing power. We have a diversified sourcing base, which we can pull from and re-resource if necessary. And we have strong relationships with our sourcing partners that will allow us to do some cost sharing should tariffs arise. So we have a number of levers that we can pull.
So Andrew, do you see any sort of impact potentially to your bottom line because of that?
Well, obviously our 2025 guidance contemplates what we can control, and that is producing great product, continuing to delight our consumer, and continuing to innovate. Obviously, we balance it with the known risks of the macro, of which I called out a couple of things on our call with regard to FX headwinds as we head into 2025 with regard to the reported growth rate. But the underlying business is really strong. The consumer continues to reflect resilient. Like I said, from a tariff perspective, should they arise, we have a number of levers that we can pull.
So Andrew, I guess given the fact that the consumer is so resilient, do you not see then the need to rely maybe on discounting so much then this year?
Yeah, I think that the strategy of discounting as a strategy for us, we are a premium product company, and we do stay away from discounting. Obviously, we'll continue to price our products in the market, and they will reflect the value to the consumer. We don't see discounting as a primary lever that we intend to use.
And I heard you mentioning pricing power. Do you anticipate, and have you already started conversations around raising prices on any items?
Well, pricing power is one of the levers, one of the three levers I talked about. We have pricing power. We also have the ability to re-resource as necessary, and we have strong relationships with our vendors whereby if tariffs do arise, the opportunity to share some of their costs with our suppliers is one. And so what we're doing is we're controlling the things that we can control. making great products, delighting our consumers, continuing to put innovation in our products, and we are well positioned, should tariffs arise, to be able to navigate what comes.
Andrew, have you seen any change just in terms of consumer behavior? And I understand that the consumer remains very resilient, but just in terms of what they are buying, what they're not buying, and maybe what you're seeing just across differences here across your various brands.
Yeah, we obviously participate in the consumer discretionary sector, and as a consumer, they will continue to vote with their wallet. And one of the things that we benefit from is we are in a space, the outdoor space, where consumers have continued to prioritize their health, their welfare, their both mental and physical health. And we provide products that sit square in the center of the bullseye of what consumers are actually desiring.
All right, Andrew Page, always great to get some insight from you. Thanks so much for taking the time to join us, CFO of Amherst Sports.
It's a pleasure. Thank you very much.
Let's do a quick check of the markets here. Just about 90 minutes into the trading day. You're looking at right around the lows of the session. You now have the S&P off, just off the lows of the session, actually. You got the S&P off about 0.9%. The NASDAQ off about 1.5%. We did see the lowest level for the S&P since mid-January. You do have the Dow barely holding on to gains up just about 0.2%. That does it for Catalyst, but coming up next, it's Wealth, dedicated to all of your personal finance needs. Brad Smith has you for the next hour. Stay tuned.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Podcast that will make you a smarter investor.
Welcome to Stocks in Translation. I'm your host, Jared Blickery. Welcome to Financial Freestyle.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
Welcome to Word Money. I'm Patrick Murphy.
And I'm Dan Coons.
From Wall Street to Main Street to the C-Suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
We are 2 hours into the trading day, and it's time for Yahoo Finance's Market Minute. Stocks struggling to snap a losing streak here. The S&P 500 on track for its 4th straight day of declines. Home Depot narrowly beating expectations in the 4th quarter, boosted by positive same-store sales growth for the first time since 2022. Still, the home improvement retailer issuing cautious guidance for the full year. Hims & Hers plunging after the company confirmed it will stop selling compounded versions of weight loss drugs. This after the FDA declared weight loss drugs are no longer in shortage, removing a loophole that allowed the company to sell the products. And crypto stocks falling as Bitcoin hits its lowest level in 3 months, now below $90,000. That's your Yahoo Finance Market Minute to keep you on track with the news you need to make smart decisions about your investments. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session. Wealth is next.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, we've got a little bit of a portfolio checkup for you. We discuss the dangers of trying to time the market and break down how investors can navigate short-term volatility. And state of the housing market. One expert tells us how improving inventory and easing price pressures should help potential buyers this spring. Plus, getting retirement ready. All week, we're taking a look at how to best invest for retirement at every age, from workers in their 20s maxing out their 401k match to those over 70 living off of those investments and sipping mojitos. Today, we focus on your 40s and 50s, your final push to save. All that and much more during today's show. But first, let's start, as we always do, taking a look at some of the market action. We are 90 minutes into the trading day. We're seeing declines across the board, fractionally for the Dow and the S&P 500, but the NASDAQ slippage is intensifying, down 1.7% right now. Let's make sense of this for you. Stocks struggling to snap a losing streak as investors navigate macro uncertainty. Joining me now on set, we've got Kevin Mon, who is the Hanian & Walsh CIO. Great to have you here in studio with us.
Good to be here, Brad.
An important day for you to be here in person as we're kind of tracking the slippage here. You're actually warning about the potential dangers of trying to time the market.
Yes.
Explain how you're viewing the recent volatility and what investors need to know.
Sure. To start, prior to yesterday, the VIX, which is a measure of volatility in the market, rose by 35%. And that caught some investors off guard. And you know why? Because last year there was little to no downside volatility, as there was less than 4% of the time the market closed 1.5% or more lower on a given trading day. That's a historically low level of volatility. But that type of volatility shouldn't cause investors to flee the markets or try and time the market. You know, Warren Buffett once said, and I agree, that the Hall of Fame of market timers is an empty room. Trying to time the market is an exercise in futility, because you got to get it right twice, Brad.
Right.
When to get out and when to get back in. It's when to get back in that is often more difficult and allows investors to fall short of their longer term financial goals.
Right, and so that's where we hear this old adage, it's not timing the market, it's time in the market here. You know, how can you really make sure that you're allocating your assets for any market volatility that you have to weather?
Sure. I think you need to stay true to your risk tolerance. In other words, your risk tolerance shouldn't go up just because the market is moving higher, just as much as it shouldn't go down just because the market is moving lower. Build your asset allocation strategy consistent with your personal risk tolerance, your investment time frame, and ultimately what your growth and income goals are. There was a study done by a University of Michigan professor, and I recognize this study is somewhat dated, but he looked at 31 consecutive years of stock market returns. And what he found, Brad, was that 95% of the stock market returns come on just 1% of the trading days. Now, I don't have a crystal ball. I don't know when those 1% of the trading days are going to be, but rest assured, if you're not in the market on those 1% of the trading days, you're likely to miss out on the most significant returns the market has to offer, and they generally come after big down days.
With all of this in mind, for some of the slippage that we have been tracking here, a lot of investors trying to figure out where they should be reallocating.
Yes.
And you have, I think, trending on social here earlier this morning, I had seen even buy the dip.
Yes.
So if you're talking to investors right now who are trying to figure out what dips feel safe, or which dips actually might have a little bit more of a dippity dip coming in later on here? It's a technical term.
Yes, absolutely.
Yes.
So I would look into those themes that are going to continue to resonate in the new year, or perhaps even over the next decade. I know the AI revolution is being called into question tomorrow. I think we'll find tomorrow afternoon, after NVIDIA reports, that the AI revolution is indeed alive and well, and CapEx spending will continue there. But don't just look at those semiconductors and chips plays. Recognize the other opportunities that exist around there. How about power solutions, utility companies, SMRs, nuclear capabilities, or even the data centers, the cooling solutions for the data centers? I could go on and on. There are growth opportunities ahead. However, we're starting to see changes in market leadership now. We're seeing value outperform growth, international outperform US. Maybe now's the time to take some chips off the table and move into other areas of the market that may provide the leadership going forward.
As we're thinking about some of those attractive areas of the market, what are you playing, what are you fading right now?
So where I really like right now, I still like the utility sectors, particularly multi-utilities that pay good dividends, have strong balance sheets, and supply electricity, natural gas, and even nuclear power capabilities. I think people are shorting defense right now. I don't think defense spending is going to decrease as much as many anticipate. If you look at companies such as L3Harris or even Lockheed Martin, I anticipate more spending in those areas ahead. And then you go away from that. How about small cap biotech? If you're looking to be a little bit more aggressive and looking for growth opportunities, I bet you there's a pickup in M&A activity, and the small cap biotech companies will benefit from that.
Kevin, thanks so much for joining us here.
My
Critical
pleasure.
day to get some analysis here and get some insight. We appreciate it, Kevin.
Thank you.
Now time for some of today's trending tickers that we're tracking during the session. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now, we've got my morning brief co-anchor, Shauna Smith. She's been hanging around here. This is hour number 3 for you.
It is. You guys can't get rid of me off set today.
We cannot, and we don't want to here. Why? Because we got to talk about Chegg. Of course, everybody's going to remember this one, especially if you went to college and purchased some books from there. All those things considered, shares of Chegg plunging after the company sued Alphabet, claiming the Google parent's AI overview feature has blocked traffic to its website. The company says it is now exploring strategic alternatives, and in its lawsuit, Chegg accused Google of unfair competition, calling it, quote, a once robust but now hollowed out information ecosystem of little use and unworthy of trust. My goodness, fighting words. Chegg, which offers homework help for students, has seen its value fall over 90% since ChatGPT launched in 2022 here. You got some real sparring words that are coming through in some of the legal filings here, Shauna.
You do. They need to do something because clearly they're having a tough time turning this around. You're taking a look at that 5-year chart. It clearly lays out just the pressure that AI and AI adoption, the Main Street adoption, has certainly put on its business. Chegg is very much trying to figure out what their place looks like here going forward, what exactly that business looks like going forward. Right now, we're right around the lows of the session with the shares off just about 31%. And I think the large takeaway here from so many of the analyst notes that I've been combing through here this morning is there's a lot of confusion and uncertainty just in terms of what that timeline looks like for Chegg in order to regain some of that lost momentum. JP Morgan coming out saying that the company continues to face secular and competitive headwinds driving to that lighter than expected Q1 outlook. Jefferies, Brent Thill over there, who comes on the show many times, saying that Chegg's business remains under major duress from AI. Piper Sandler also weighing in, pretty much affirming some of that sentiment, saying that subscribers are continuing to decline, a lot of that being pressured by AI adoption. So very much a clear takeaway from the street is there's a lot of concern, a lot of worry just about the continued pressure that AI adoption is going to put on Chegg's business. And there's a lot of questions as to whether or not the ability here to turn things around.
Yeah, down 30% on the day, now sitting just above $1 per share here. We'll continue to track that one. We're also keeping close tabs on Block this morning. Block getting a post-earnings upgrade to equal weight from underweight at Morgan Stanley. The analyst says that valuation is reflective of risks that they've outlined, including skepticism of Square seller growth acceleration. And Cash App valuation now matches the firm's expectation. Shares right now down by about 3.7% here. So a little bit of the evaluation that they have continued to run the calculus around here and kind of saying, yeah, this is exactly what we expected.
It very much is. When you take a look at, if we could pull up a 5-day chart, I don't know if we have that ready here, but a 5-day chart shows the decline that we have seen seen in block shares since we did see that release. You're looking at the stock still off just about 25%. So very much this is a valuation call. Morgan Stanley, the latest name to come in, saying that it's now the risk, the sentiment and positioning, I think, is a little bit more balanced. This also follows a call that we got from BMO earlier this week. They also upgraded the stock. They actually did outperform from market perform, so a bit different than what we're hearing from Morgan Stanley this morning, who upgraded it to equal weight from underweight. But again, very much saying that they think the current valuation incorporates some of that increased skepticism. Block's ability to accelerate Square seller growth here is critical here to this upgrade. Their new price target of $65 a share, just about $1.50 higher than where we're trading today.
All right, Shauna, we finally release you from the set here today.
Thank you.
This morning,
for now.
right now.
I'll be back at noon.
Thanks so much for sticking around. Appreciate it. Also tracking consumer confidence, posting its biggest monthly decline in nearly 4 years, falling to 98.3. That is below the expectations for 102.5. The Conference Board says inflation expectations surged as investors digested an increase in prices for staples like eggs and the expected impact of tariffs. So we want to dig into some of this uncertainty and talk about how investors should be positioning themselves in the current environment. Joining me now in studio, finally live in living color, we've got Anthony Siccaro, president of Providence Financial Insurance and Services. Anthony, great to have you here with us this morning.
Thank you for having me. Great to be here.
Absolutely. So let's talk about this. You are calling for a measured approach for investors here. Walk us through that.
Sure. Well, the consumer confidence obviously has been down, and there's really nothing that's going to tell us that it's going to increase from here. It's all about inflation. It's all about tariffs. And as much as we would like President Trump to come out and say, look, guys, I'm just using tariffs as a political ploy. I'm really not going to impose them on anybody. We know that that's not going to happen. And we don't really know what's fact and what's fiction at this point. So the fact is that he is wielding them, but we don't know where that leads. If it's 10% or so, if they're real tariffs and 10%, companies can absorb that.
Sure.
And so I don't think that'd be a big deal. But if it gets higher than that, if it gets into some of the 25% range that he's talking about, now all of a sudden consumers are going to have a problem. But this is weighing on consumers' minds. So the sentiment is down because they believe that if he does wield them as a sword and if they do stick, then inflation's going to grow, and no one wants that. That's why consumer sentiment is down.
So what's the pass-through here for different generations of investors, say younger investors? Let's begin there. You say you should continue with the dollar cost averaging strategy. What does that look like in effect?
So dollar cost averaging is just buying the same thing over and over again. For those of you that have your 401ks that you're just having money taken out of your check, what you're doing is you're dollar cost averaging. And what it does, Brad, is it drives the average purchase price down, which is exactly what you want. You want to drive the average purchase price lower. The fact is that if you're doing that and you're in that younger generation, keep doing it. Volatility actually helps you, because if you're buying consistently and the price comes down, then what's going to happen is you get to buy more shares for the same dollar. It's not bad. If you're closer to retirement, though, or you're in retirement, now all of a sudden you have to worry about a major pullback at the wrong time. If you're going to retire in 2 or 3 years and that market crashes maybe 20, 30 or more % from that, now it could cost you your retirement. So if you're younger, keep dollar cost averaging. If you're a little older, might not be a bad time to reposition into something more conservative. And my preference is to focus on things that pay interest and dividends, because those are the eggs that you can count on.
Certainly. And so as we're thinking about that, let's delve a little bit further into those who are closer to retirement age. Where are the assets that you are seeing more people who are retirement ready and their savings feel like they're in a good spot to finally say, okay, maybe this year, maybe next year, 2 years from now, that we are retirement ready, but we still need a portfolio to kind of balance some of the opportunity that are still out there in the market?
Sure. Well, what you need to know is that almost any investment out there can be focused on either growth or income. Think about stocks. Yep. You have growth stocks out there that are high multiples and with the idea that the company is going to grow into the price, but there's no income. Yeah. Or you can buy dividend producing stocks that are going to pay you income, and the income is like the bird in the hand. You can count on that income. And so stocks is one example. Same thing with bonds. You can buy zero coupon bonds that don't pay you any interest at all until you cash them in later. Or you can buy bonds that pay income. So the reality is there's a whole universe of investments out there that are dividend and interest focused. Stocks, bonds, preferred stocks, business development companies, REITs, flavors of annuities that are all income oriented. And the income is the bird in the hand. You can count on it. If the market stays choppy for the next decade or so, and that's happened many, many times where there's been a decade or even 2 where there's no growth at all in the market, choppiness, but at the end of the day, no growth for 2 decades. A lot of people don't know that. If you're focused on dividend investments, then the fact is you're getting paid to wait. And it's those dividends and interest that will come in and save the day.
What's the calculus that those who are closer to retirement should be running around corporate bonds versus treasury bonds, for instance?
So there's a spread, and it really depends on what that spread is as far as whether you should be doing corporates or treasuries. Usually it makes sense to invest in high investment grade corporates over treasuries. Right now the spread's probably 75 basis points and, very good. But as far as the calculus for you, for income, it really depends on how much income you need out of your portfolio. If you're retired and you're living off the income in your portfolio, you want to have a much higher degree so that you can live off that income, the interest and dividends. Whereas if you're retired and you don't need the income from your portfolio, then you can take that, put it back into more frothier, growthier stuff if you want, and you have time to write it out. But if you need the income, the more income you need, the more you want to have in income producing investments.
Anthony, great to have you in studio with us today.
Thank you, Brad.
Appreciate it. Coming up, everyone, the state of the housing markets. We discuss the latest trends in home prices and talk about the spring buying season. Stay tuned. Home Depot reported an increase in same-store sales for the first time in 8 quarters as homeowners and professionals both spent more on home improvement projects. And here to help break down what Home Depot's results mean for the housing market, we've got Yahoo Finance's Danny Romero. So what does it mean for the housing market right now?
Well, let's just start with the earnings, right? Home Depot executives were very happy with the positive comp sales, but it's important to know that Home Depot's CEO, Edward Decker, sees little life in housing turnover. So that's the change of hands between one house and the other house. So remember, over the past few years, the company has pinned their problems to the challenging housing market. But these issues will likely persist. The company projects a 1% growth in same stores sales. So remember, the point here is that high home ownership costs have contributed to the slump in existing home sales and also the reduction in home improvement spending. So, the executives here really aren't expecting a significant housing recovery here. So, this was just really shine the light on what can we expect here. Will people continue to stay at their house and, remodel it, or will they just put off the projects for a later date?
Yeah, that's major. The company's saying that the results exceeded their expectations. However, they did acknowledge some ongoing pressure on large remodeling projects, to your point here. We also got some housing data out this morning. Big day for housing. Case-Shiller, S&P Case-Shiller CoreLogic Home Price Index, that showed home prices increased 3.9% in December. What are the biggest takeaways from this report?
Home prices rose faster in December than last month. So really just providing little relief for home buyers. The S&P Case-Shiller National Home Price Index did, like you said, rose 3.9% from the earlier year in December. On a seasonally adjusted basis, remember, this data captures a 3-month period through December when mortgage rates were just hovering around that 7%, a double whammy for buyers. And so the national index did hit a record high for the 19th consecutive month. So the thing interesting really here is that one of the analysts at S&P Case-Shiller, he highlighted and said this, and this was just, I think, the icing on top. He goes, through this recent market cycle, the ability of Americans to grow wealth by participating in the upside of the U.S. housing market, particularly if done through a leveraged position by securing a mortgage, has proven to be historically beneficial. And I thought that says a lot, right? That homeowners have a lot of equity, and if they got in at the right time, that they're able to have some of these gains that we're seeing in home prices. The other thing is the index tracking home prices in the 20 largest metropolitan areas gained 0.5% in December, and also the largest 20 city index jumped 4.5% compared to last December. So really, I mean, it's just really highlighting that home prices in 2024, they hit a record high.
You know what's not great in this report for us? New York reported the largest annual gain again here among the 20 cities in that 20-city composite here, posting those year-over-year increases of 4.5%.
But we could say that could be an influence of people moving back to the Northeast because of work. Yeah. Because of work reasons,
Return
right?
to office mandates.
Exactly.
Yeah.
So we could see that big jump.
Yeah. We're going to be continuing to track it very closely here. We got a lot more housing data coming out this week. Danny, thanks so much for breaking this down for us. Appreciate it. Using a different gauge than the Case-Shiller, annual home price growth pulled back in January, falling to just over 3% from around 3.4% the prior month. That's according to the Intercontinental Exchange's Home Price Index. Here to dig into the data and what it means for the housing market heading into the busy spring season, we've got Andy Walden, who is the head of mortgage and housing market research at Intercontinental Exchange. Great to have you here with us, Andy. So just take us into the reading as per the ICE metrics.
Yeah, and I mean, we saw the same thing late last year, right? So when you look at late 2024 home price growth, it picked up a little bit over the last 3 months of the year, according to our index as well. We're starting to see an inflection, though, as we move into January, and that annual home price growth rate is starting to come down. If you look at the better part of the last 9 months, we've actually been operating closer to a plus 2% annualized growth. So it suggests that, you're just talking about those high levels of home price growth. That annual growth rate could start to ease here over the next couple of months as, it more accurately reflects what's actually been happening here more recently in the market.
But we're still essentially within the same ballpark mortgage rate as we were this time last year. So there hasn't really been a ton of movement. How is that anticipated to be a differentiating factor this year versus last year?
Yeah, and it's slightly better as we stand here today than it was at this point last year. The other thing to keep in mind is as we move our way through 2025, if you look at the futures market and where the street is kind of placing its bets in terms of where mortgage rates are going to go, you're likely to see about 0.25% relief in mortgage rates. At least that's the anticipation right now as we make our way through the year. And so a little bit of a modest reprieve in home affordability as we make our way through. The other thing that's very different today than it was a year ago is that there's more homes out there available for purchase. So if you look at the market in January, there were 25% more homes available to buy in the market than there were at this time last year. We're seeing the strongest inventory levels, even though we're still running a deficit, the strongest inventory levels that we've seen really in the better part of the last 5 years out there in the market. Now, you guys were just talking about New York City and home price growth that still remains strong in that area. There's a lot of variation across the country in terms of inventory deficits and where we stand right now. The Northeast is really still starved for inventory. And so that's why you're seeing some of those stronger home price growth rates up there. When you look across the Sun Belt, a good chunk of those markets are back now to pre-pandemic levels of inventory, and that's where you're starting to see prices soften.
Okay, and so there we go. We're taking a look at some of where prices have softened, and a green arrow in this context means good, even though it's pointing down, because ultimately that's some relief for potential buyers out there. All those areas that you're tracking right now, how much of this can you tie back to some of what we were discussing in return to office mandates, or just migration that now once again has to unwind because we can't be as hybrid as we were before, I guess?
Yeah, it's a combination of all of those things. And when you look at the Sun Belt, you start to look at new construction activity down there as well. There's a stat that 3/4 of new home construction coming to market last year actually came in the Sun Belt. And so that helps for some of those existing homeowners that are still locked into their homes by low rates. You're seeing some of that new construction inventory help with the supply constraints down there. You're also seeing a number of other factors, rising property insurance in those particular areas, the migration inflow that's slowed down into those particular areas, back to office in New York, right? So there's a number of different factors that are contributing to this, but really it's that inventory component. It's not so much affordability that's driving price right now or the lack thereof. It's inventory. And when inventory returns, you're seeing those prices soften up. In areas where you're not seeing that inventory return, the Northeast most notably, you're seeing still firm home prices.
With that in mind, as you're thinking through some of the policy implications that could have an impact on housing, whether that's the workforce and immigration policy impacting the number of available workers to build out homes, and then additionally on the materials itself, if we do see tariffs go into effect, how could that also have larger impact on the cost of new home build-outs?
Yeah, you're absolutely right. That new home construction is where that would come, both in terms of the lack of labor from that lack of immigration out there in the market, along with tariffs. If they're put specifically on lumber or construction materials, that can have an upward pressure on homes that would be coming to market over the next couple of years out there in the market. So something certainly housing market folks have a close eye on. What do we truly see in terms of these tariffs? You were having that conversation earlier in the show. What do we see in terms of immigration and the costs of this construction, and how does that play into the market as well?
As we're taking a look at some of the home builders here, home builders rallying on the day, at least during this activity. Andy, we're going to continue to track this very closely here. We appreciate you taking the time.
You bet. Thank you for having me.
Coming up, everyone, congressional Republicans are taking aim at 2 new rules from the CFPB. Find out what these rollbacks could mean for you and your finances next. Congressional Republicans taking aim at two rules designed to protect consumers created by the Consumer Financial Protection Bureau in the final weeks of the Biden administration and potentially blocking them from ever taking effect. Here to break down the rollbacks, we've got Yahoo Finance's Jordan Weissman. Jordan, let's start with the cap on banking fees. What do we know there?
So during the Biden administration, the Consumer Financial Protection Bureau capped overdraft fees at $5, right? We all had an overdraft fee at some point. You accidentally took your account below zero without realizing it, and you get hit with like a $30 charge. Everyone hates it. The CFPB said no more. We're going to cap them at $5 or no more than the cost of offering that quote unquote service. This was part of Biden's war on junk fees. What's happening now is the Republicans in Congress want to use a law known as the Congressional Review Act to try and undo that regulation. And what the Congressional Review Act does is it lets Congress and the current president basically scrap recently finalized regulations, whatever the last White House was doing at kind of the last minute during its term. So, what it means is that this rule that was going to make all of us have to worry a little bit less about, getting hit with a surprise charge is probably going to, it's going to say goodbye.
There's also a rule regulating digital payment apps. So what's at stake for consumers there?
Right. So this one isn't going to hit consumers necessarily as directly, but it's still important. Basically, what the CFPB did was towards the end of Biden's term, it finalized a rule saying we have authority to supervise digital payment apps and digital wallets, Venmo, Apple Pay, and potentially if Elon Musk's X ever launches a large payment service, they could have been covered by this rule. And what supervision means is it's sort of a term of art. It means that regulators get to go in and proactively look at what companies are doing and make sure they're not violating any laws. The CFPB already supervises big banks to make sure they're not violating consumer protection laws. This would have subjected payment apps to the same sort of regulation. Tech companies didn't particularly like it, and already Republicans are signaling they might try to scrap this rule also.
Jordan, thanks so much for breaking these down, tracking these developments as well. We appreciate it.
Yeah, thanks for having me.
More than 3/4 of Americans cutting back on spending in effort to navigate persistent inflation, according to the latest Wells Fargo Money study. Here with more on the study's findings and what it tells us about the U.S. consumer, I'm joined by Michael Learsh, who is the Wells Fargo Head of Advice and Planning. Michael, great to have you back here in studio with us this time. So let's start there. How does the cutback in spending compare or stack up to last year?
So last year, it was about 67% of Americans say they were going to cut back on spending. But what's more interesting, Brad, is the generational cut. So think of those Americans in their 20s, 30s, and 40s. They're cutting back the most, but in favor of saving and investing. So the majority of those audiences say they want to save and invest more this year as well.
Okay, so they just want some time in the market here, based on some of the other conversations we had earlier today as well. Many Americans are delaying, it seems, as well, the plans of, other just broader life goals as well as part of that spending pullback. Where are you seeing them cut back specifically?
So it's interesting. We're seeing vacations in particular being where a lot of people are making trade-offs. And that makes sense, and they're not saying they're not going to do them. They might be delaying them, doing those vacations a little bit differently, maybe, again, cutting back on expenses. And you had a lot of the kind of home data. A lot of people are reconsidering when they want to do a home renovation or relocate or buy a new home. So there's just a lot of uncertainty out in the marketplace right now, and people are trying to make those good trade-offs so that they can sustainably, Brad, meet their savings and investing goals.
So not quite taking the White Lotus trip, but maybe just popping over to the beach or something for a weekend. Who knows?
Yeah, absolutely.
Yep. Turning here as well to sticker shock, because this was interesting as well. How are Americans across different incomes just feeling about prices right now?
So when Americans, we ask them about very basic things, tank of gas, going out to eat, and buying a bottle of water. So think about a bottle of water. Americans said they expected to pay about $1, Brad, and they really paid $3. So in just those life basics, they felt like inflation had really caught up with them. And that's what's driving a lot of this reprioritization, which is actually exciting because people want to align their values with how they're spending rather than just going through life and doing things more out of convenience.
Was there a specific item that jumped out to you that costs more right now than people expect, that's catching them off guard?
So birthday and holiday cards actually caught me a bit off guard. So it was $3 that people expected to pay, and then they turned over the card and they were paying $6. And you can imagine at the holidays, and people probably remember it very recently, that can be a lot of money if you're buying 5, 10 cards for your friends and family.
Yeah, all right. Good for me. I have a binder. I save everybody's cards that they give to me, so just know I keep them. So as we're thinking about where people can ultimately find some relief here as well, what tips do you have for those who are looking at the sticker shock or looking at the prices of things or even delaying some of the life plans and just trying to get into better stature to position themselves to be able to execute on all of the things on the vision board?
Absolutely. So I'm going to anchor in what Americans told us. So they said they wanted to reset their financial habits. And when we looked at the data, though, they were also keeping money kind of a secret in terms of what they were doing with it. So what I would encourage Americans to do is find a trusted partner or professional, Brad, and really share what's going on with their money. And then in that way, to your point, have that goal board, align what you're doing with your money, with your values, and how you intend on spending it. The second thing Americans said, and I mentioned this, is that it's the right time to save and invest now. So in the same vein, what does that mean to you? How much do you want to save? What are you investing for? Is it retirement? Is it just to build wealth? Really focus on that and get it done, because Americans said the time is now to save, invest for your future, and also to make sure you're being very intentional about it.
I'm going to marry together two thoughts here. One in the conversation that we're having, and then another in what we were discussing the other day with layoff anxiety that's very real right now for many Americans, as shown up in one of the studies that we were discussing just yesterday. As you're kind of thinking through the number of people in the workforce that have that anxiety about layoffs and also trying to monitor their finances, is one translating into, or at least transpiring into, purchase habits as well and perhaps having some impact there?
So we did look at income data.
Okay.
And so for those people who are higher earners, I will tell you, Brad, they're still saying they want to cut back on spending this year. And about half are saying they want to do that for the highest earners. So to your point, you could call it anxiety, you could call it uncertainty, whatever you want to call it. People are aware that there's uncertainty in the economy and they want to manage to it. And what's great about it is Americans aren't just living their lives and going about business as usual. What they want to do is take control and agency of their own financial lives and future.
Some really great insights and context here. Michael, great to see you. Thanks for joining us.
Great to see you too.
Before we go to break, this Black History Month, we celebrate the power brokers in business, the executives, the entrepreneurs, and proven change makers who have advanced economy and society. Fawn Weaver is the Grant Sidney CEO, co-founder of Uncle Nearest, and two-time New York Times bestselling author. She's known in the spirits industry for her leadership of Uncle Nearest Premium Whiskey, which is founded to honor Nathan Nearest Green, the first Black American master distiller who mentored Jack Daniel of Jack Daniel's whiskey fame. With Weaver at the helm, Uncle Nearest has become the top-selling Black American-owned spirits brand with a valuation exceeding $1 billion and tripled sales between 2021 and 2024. She also co-established the Nearest Jack Advancement Initiative, a partnership with Jack Daniel's aimed at promoting diversity within the whiskey industry. Coming up, we have some advice on saving for retirement in your 40s and 50s. Stick around. This week on Wealth, we're taking a look at how to best invest for retirement at every age, from workers in their 20s maxing out their 401k match to those who are over 70 living off their investments. And today, we're narrowing in on how to save in your 40s and 50s. Fidelity found that the average member of Gen X has an average of $192,000 saved in their 401k, but also have the highest rate of outstanding 401k loans out of all generation. Here with some advice for the middle-aged retirement savers, we've got Andrew Fincher, who is the VLP Financial Advisor. Andrew, good to have you here with us today. How much should people have saved by their 40s?
Yeah, Brad, thanks for having me on. Really appreciate it. So it's something we like to say in the industry, and I know people want a number, but it really depends, right? So you got to really think about where you're coming from. It factors in cost of living, taxes, and lifestyle as well. Some people want to live off of 150,000 a year. Some people are comfortable with 50. And so when you look at it that way, what we try to see is goals-based planning. What that means is see what your future looks like. What number do you have to live off of? Consider costs such as cars that you need to repurchase, care, in retirement, and then work backwards to see what assets you have to know how much each year you should be putting for retirement.
That's nice. I like that goals-based planning here. Okay, so how do you run the prioritization calculation around that goals-based planning?
Sure. So we do categorize it into needs, wants, and wishes. So your needs are definitely going to be your typical retirement savings. We typically break out of that your medical care, so your Medicare premiums. If you have private insurance, what does that look like? And then again, vehicle repurchases. If you go over to the wants, that's sort of vacation, right? People typically, maybe you want to travel abroad, maybe it's just to the lake down the road. Either way, there's a cost associated with that. And then wishes is, maybe you want to pay for your children's wedding, or maybe you want to leave a bequest to them, or charitable contributions, whatever that is. We categorize it to know you need to start at the needs and then work your way down and see what probability of success is for that.
So how do catch-up contributions work for those who feel like they're a little behind the eight ball, or perhaps not at that $192,000 in their 401k? What can they do to catch up?
Sure. So this is a great wrinkle that was just added by Secure Act 2.0. So I know a lot of people know the deferral number is 23,500. However, there's these new layers with the catch-up. So between ages 50 to 60, you can contribute an additional $7,500 for $30,000 total. And then on top of that, from 60 to 63, there's the additional $11,250. So Congress got together, and if you have cash flow that allows for it, it not only helps you save for retirement, but also reduces your current tax liability as well if you're in higher tax brackets.
And what is the best way to go to just calculate how much you need for retirement?
Sure. So, a lot of factors in that. Inflation is going to play a role, right? So typically you got to look at inflation from a 3%, maybe 2.5% if you're quite bullish on it. Medical expenses, 5.5%, 6%. If you're saving for college, for instance, that's even going to be higher. And you got to look maybe more specifically on which college, because again, private could be more expensive than public, depending on the state. So factoring in these things, if you utilize software, we utilize a software called Money Guide Pro. There's others called eMoney. Banks have them as well. But if you put these factors in and try to make sure that you're including appropriate amounts that are going to grow each year, that allows you to work backwards to say, hey, this is the amount that I need to put in to be able to get to our goals.
So what are the percentages that you need to think about saving for different types of expenses, right? Because it's not just like you're going to draw upon this figure, be able to go upon some vacations to some perhaps lavish destinations, and then also you're going to have your normal expenses, your house, maybe some medical things that pop up too. So how do you go about calculating those specific percentages in each of those buckets?
Sure. So obviously the large base is going to be your living expenses, right? Just your groceries, if you have a mortgage or rent. Car purchases are going to be a big part of that as well. And so typically you have a good idea of what you're spending. If you don't, always look at your budget, see if there's margins that you can sort of create that cash flow. As far as other things, whether it be vacation, it's sort of you have to weigh your options there. So maybe a typical vacation for you is 5,000, 10,000. You look into that. That's the great part of these softwares is it actually will shoot out a probability of success for you. So if you utilize this and say, oh, maybe you want a stretch goal of 15,000 for a vacation, put it in there, see the probability, then you can lower it and go through and see, okay, this is the constraint that we have for this specific goal.
I can't wait until my average vacation is 5,000, 10,000. Andrew, you've put an aspirational goal out there for me, and now I've got to work with ChatGPT to figure out how I can get to it. Andrew, appreciate it.
Appreciate it, Brad.
A programming note, in this week's special episode of Decoding Retirement, host Bob Powell speaks to Wharton School professor Olivia Mitchell, who shares results from a study that looked into financial regrets in an older age. Take a listen.
Well, we've done a fair amount of work trying to study what older people do regret. And we were surveying people over the age of 50. And we asked them questions like, we didn't use the word regret because that would have been too leading, but we said things like, looking back, if you had to do it over again, would you have liked to have saved more, about the same, or less? And a majority of the respondents said they wish they had saved more. Only 2% said they wish they had saved less. So definitely regret for not having saved more along the way was very salient.
You can catch episodes of Decoding Retirement Tuesdays at 12 p.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. Coming up, Yahoo Finance's tech editor Dan Halley breaks down the journey of how NVIDIA grew from a gaming company to Wall Street's AI darling. And ahead of NVIDIA's earnings report Wednesday, Yahoo Finance, guess what? We went to the streets, to New York, to ask everyday investors how they're deploying their cash and whether or not NVIDIA is part of their portfolio. Take a listen.
I hold about 25 different stocks.
Currently, I like to invest in a lot of AI.
AI is the future.
With the rising AI.
I don't own NVIDIA. I just haven't invested in specifically because I felt like I missed out on the wave.
No, I'm not invested in NVIDIA. I haven't really followed the hype train too much on it.
To be honest, I don't keep too much track of NVIDIA at this point.
I only owned NVIDIA shares as part of like an ETF or a mutual fund. If it were 10 years ago and the price were a lot lower, I would have bought a lot of individual shares of NVIDIA.
If I had the money, I would definitely invest in NVIDIA.
I have some NVIDIA, but I sold most of it. I thought that my money could be like better spent somewhere else. If I had more money, I would buy more NVIDIA.
I like NVIDIA a lot. It did become one of my top stocks. I bought into it a long time ago, around COVID, and then I just got super lucky. I wouldn't buy any more NVIDIA, so the price is a little too high for me.
I bought shares last year when they were, well, maybe not the best time because they were really high. I do follow the earnings report of NVIDIA. I think it's definitely going to be positive.
With a market cap of over $3 trillion, NVIDIA is the second largest company in the world and a major influence on the U.S. market and beyond. The company has been public for more than 25 years, long before artificial intelligence was dominating headlines. So where did the company begin and how did it get to where it is today? Here to explain, we've got the tech editor for Yahoo Finance, Dan Howley, breaking it all down for us in the evolution of NVIDIA.
Yeah, Brad, this is a company that started off really primarily on video games. I know a lot of people are aware of that, but they are also consider themselves the creator of the graphics processing unit. That was the original GeForce 256, and the graphics processing unit basically was a way to offload some of the calculations that a CPU would use when rendering games. And so they managed to come up with that. And that basically helped video games kind of explode as far as graphics capabilities. They are since now used in high-end gaming PCs. I have one in my PC. The original Xbox was powered by a GeForce chip or an NVIDIA chip. And so is the Nintendo Switch, believe it or not. It's a Tegra chip that kind of came around when NVIDIA briefly got into smartphone sales. But they've also been able to see over time through research that these cards are great at something called parallel processing. And so as a result of that, they can handle certain tasks a lot more efficiently than a CPU. And so over time, researchers started to realize this and experimenting with the power in different applications. Then in 2006, NVIDIA released what it calls CUDA, which essentially opens up its hardware for use by researchers for general purpose processing. So this is GPU, general purpose processing, and it's basically the foundation of what we have today with AI. Then in 2012, there were a trio of researchers, including Ela Stutzkever of OpenAI, co-founded OpenAI. They came together and created what is called AlexNet. It was a neural network. It won the ImageNet image recognition competition. Basically, this is considered to be a seminal moment in the AI revolution. It was able to figure out how to find a photo of a cat. And it's been this enormous kind of, people call it the Big Bang moment for AI. After that, NVIDIA, Stutzkever ended up going on and opening up OpenAI with Sam Altman, Elon Musk. Later, in 2016, NVIDIA actually delivered its first DGX-1 supercomputer to OpenAI. And we have this image here with Musk looking at it with Jensen there standing alongside him. And that's the original DGX-1 computer. And then obviously in 2022, after all of this kind of work was going on, OpenAI finally launched ChatGPT. And that set off the current AI wars that we're seeing today, where we have Claude, we have Gemini, Claude from Anthropic, Gemini from Google, as well as a slew of others. Microsoft obviously investing heavily in OpenAI over the years, and now Elon Musk split off and has XAI. And so there's all of these different companies now that are just going bananas. We're seeing the stocks jump on these kind of companies, AMD fighting to get in the space, Intel as well, but it really is NVIDIA's game, and this is kind of how it's gotten here.
All right, earnings coming this week, the 26th. Dan, can't wait. Appreciate it. Everyone, that's it for Wealth. I'm Brad Smith. Thank you for watching. Stay tuned. Market Domination comes your way at 3 p.m. Eastern Time. They'll count you down to and through the market close.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Podcast that will make you a smarter investor.
Welcome to Stocks in Translation. I'm your host, Jared Blickery. Welcome to Financial Freestyle. Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
Welcome to Word Money. I'm Patrick Murphy.
And I'm Dan Coons.
From Wall Street to Main Street to the C-Suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
We are 2 hours into the trading day. It's time for Yahoo Finance's Market Minute. Stocks struggling so far today. The S&P 500 on track for its fourth down day in a row. The major average hitting its lowest level since mid-January. The Nasdaq is off just over 1%. The Dow, though, barely holding on to gains. Tesla leading the Mag 7 declines, its market cap falling below $1 trillion. New sales data out of Europe showing that sales there declined 45% in January. And Apple shareholders voting to keep the company's DEI programs, rejecting a proposal that would have scrapped those efforts. The company conducting the vote as part of its annual shareholder meeting. And crypto stocks falling as Bitcoin hits its lowest level in 3 months, now well below $90,000. Bitcoin is down roughly 7% in 2025 so far this year. You're looking at a huge decline today, as well as some of those crypto stocks. Well, that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.